they've shown that if you give enough fiscal stimulus, you can get a strong economy.
Each central bank is trapped, and they're not going to be able to exit this unconventional monetary policy.
They're all using models that are traditional models, but this has been a very non-traditional recession.
Monetary policy cannot combat the major problem to the economy.
Having some cash to deploy and look opportunistically for sellouts is a good idea.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures up 0.2% on the S&P, closing dead on 4,400 on the S&P at the close yesterday, Tom. It's as if the Federal Reserve meeting at that news conference never happened.
Yeah, mission success for Chairman Powell. I think Johnny got what he wanted, which is some huge stability there. Mike McKee really pushed back on some of the themes that were controversial in that. And I'll say, they're there. They're on their way to the next meeting, and they have to get more data in. We're going to get data on GDP today and also some wonderful conversations. We have a very strong lineup today, John.
Looking forward to that. Up 8 on the S&P 500. Not much price action to speak of. Let's take a look at one name where there is some significant price action this morning. In the pre-market, Didi Global absolutely flying, up by more than 30 percentage points. Tom, this from Dow Jones. Quote, ride-hailing giant Didi Global is considering going private in order to placate authorities in China and compensate investors for losses incurred since the company listed in the U.S. in late June.
Manipulated going. It's a Dow component. Manipulated
that,
going down. Manipulated.
What is that?
I just don't think it's that big a story. I think this is the manipulation of capitalism by the Chinese government. It was manipulated on the way down. Guess what? It's manipulated on the way up.
And I think many people would agree with you,
Tom. Do you think the government, John, has any interest in the privatization of Didi? I would suggest they do.
Lisa?
Yeah, I think that, look, they're going to placate the Chinese authorities. This is significant to me, especially in light of the move that we're seeing more broadly in the Chinese equities that suffered most severely over the past couple of days. Authorities held in a meeting with banking executives last night in China. They were concerned about some of the market moves. The fact that they are concerned about market moves is new and giving people some encouragement. However, John, and this perhaps addresses Tom's it's the authorities still could potentially crack down with further regulations. There is a regulatory uncertainty in China that wasn't there just a few weeks ago.
Please don't validate the sound effects, Lisa, this early in the program. We don't need any more of that. Let me get to the price action. The S&P 500 up 8. Thank you. Up 0.2%. Outside of that, into the bond market, yields higher by 3 basis points to 126.59. You have a drink, TK.
Stronger renminbi, John.
Euro stronger too, Tom. Dollar weaker. Euro dollar 118.74. Positive 0.2%, Lisa, on euro dollar.
To be some important data points that I am looking for. Tom mentioned this, the 8:30 a.m. data dump, including U.S. GDP. We're expecting 8.5% on an annualized basis, a near record pace, up from less than 7% in the previous reading, 6.4%, I believe. The key issue here is there any sign of a slowdown, of the deceleration that so many people are expecting? Michelle Meyer over at Bank of America, economist there, really talking about how this really will likely be peak growth. We will moderate from here. And I guess for stocks, does moderation equal a decline, or is this okay and exactly what people want to see? We're also going to be getting initial jobless claims. And I think this actually may be a more important initial jobless claims report than we previously got following Fed Chair Jay Powell and basically his emphasis on all jobs data coming out in the next few months. Then at 1 p.m., the U.S. is planning to sell $62 billion of 7-year notes. There's been no drama in the auctions this week. However, 7-year is the bogey. This is the question mark. This is the one that tends to have some volatility. Is there any pushback after yields went lower on a seemingly perhaps patient Fed Chair Jay Powell? However, they are still planning to taper at some point. So, how much does that factor into prices? And then aftermarket, Amazon is set to report earnings. We haven't talked about Facebook, actually, last night, down sharply in a pre-market open. And the question for Amazon is going to be somewhat similar. What kind of regulatory pressure are they facing? But really, people are going to be looking at also labor force issues, the idea that they are getting pressured by unions to raise some of their wages, as well as, of course, cloud computing, John.
Lisa, thank you. And after the market, Amazon, and then on to what? After that, feels like we're done. Feels like we're done after that, doesn't it, Tom? After you've worked through Amazon.
Yeah, I get that whole tech thing and the juggernaut, and we'll sum it all up. But, John, I think I'm jaded on it. I look at the Bloomberg terminal. ECO Go is a great function. How do you justify 8.5% survey GDP with what Powell said yesterday about jobs? What an odd American economy.
We've got much, much more work to do, apparently, Tom. Let's bring in David Rosenberg, Rosenberg Research founder and chief economist. David, you've done a wonderful job through the year so far, really pointing out the issues in this argument for people who think it's not transitory, for people who think it is. Just frame it for us, David, your view on inflation dynamics in America right now.
Well, look, it's what I was saying earlier, and I think that Jay Powell touched on it, which is just the extremely narrowly based run-up in prices that we're seeing. I mean, remember, there's thousands of things that go into the CPI, and you've got a handful. Really, what's carrying the load on this inflation bulge is 10% of the index. And the things that are being distorted by either the indirect and direct impacts of the pandemic, which we're still in, and anything related to the supply chain bottlenecks, which the CFO of Qualcomm yesterday said are probably going to be resolved in the first half of next year. So this is not a repeat of the 1970s oil price crisis, which people talk about. But look, I just cite really one statistic, which is this. 10% of the core CPI year over year is running at 20%, and that's huge.
Right.
But the other 90% is running at 2% year over year. Well, and that's the real story. Is the 10% carrying the load going to converge on the other 90%, or do you believe the 90% is going to converge on the 10% that's created the inflation bulge over the past few months? So it's really just, look, you have to take a look at these price statistics. I don't know why the bond bears and inflationistas can't just see that an equity market analyst will always look at the dispersion and the breadth in the stock market. Well, you have to do the same thing in the economic data. And I wish, actually, that Powell had spent more time on this yesterday.
Yeah, I agree. David, I strongly agree with that. Carl Riccadonna agrees with you as well. He has a brilliant note for Bloomberg Intelligence this morning, folks, saying 85% of inflation is basically stable. David Rosenberg, why did Jerome Powell not bring up the trim mean of Dallas, the good math of Atlanta, and as you invented, basically, for market economics, the brilliant work of the Cleveland Fed? Where was he on that?
Well, look, I think that he had to walk a fine line, and he's under a lot of criticism, even from former Fed officials. So I think he did a pretty good job in his balancing act yesterday. He didn't mention these other particular statistics. Of course, he doesn't want to lose the audience, but he came out and said what I've been saying, and it just took really one sentence, which is that this is a very narrowly confined, although rather dramatic increase in prices in sectors that account for really a small share of the CPI. And I'll just go back and, yeah, you're right. I would have just gone back and said, look, the last time we had this gap between the Cleveland Fed median and the headline inflation rate was back in July of 2008. And if you go back to that period, oil was $140 a barrel. Nobody was looking at around the corner what was going to happen to Fannie and Freddie and Merrill and AIG and, of course, Lehman. A year later, inflation's -2. It's no longer plus 5.5. And I think, actually, by the way, I think this time next year we will be back talking about disinflation or deflation, just simply because the base effects are going to work in the other direction this time in 2022. That's what people aren't talking about.
So David was talking about looking around corners. Let's try to look around corners with the housing market, because this is one of the key questions. And Fed Chair Powell seemed to indicate that their mortgage debt purchases has not been overly inflating housing prices, that it acts as a stimulus, basically the same as Treasuries, and that they'll probably pare back the purchases on a monthly basis of both in equal tandem. That seemed to be what he's leaning toward. Do you agree that this is the right policy, that the mortgage debt purchases don't unduly affect housing values?
Well, I would say, look, housing is an extremely complex market. There's no doubt at the margin that the Fed's mortgage-backed security purchases have been a help, but there's so many other factors that have been at play, and a lot of it is how people have reacted to residential real estate, and the demand for more space has been a key factor here as well. That's driven the housing market. But, I'll just say this much. He comes out and says that the housing sector remains very strong. I almost fell off my chair I mean, we've had new home sales peel back significantly 3 months in a row. The mortgage-backed application numbers for new purchases have dialed all the way back to the levels of May of last year. So the housing numbers are actually rolling over. I'm stunned that so many people still think that residential real estate is in a bull market. Now, maybe the prices are, but we're seeing a thaw in the inventory, and with a lag, that's going to cause these house prices to start reversing course before long. But the housing market on its own, even with the Fed's assistance, is starting to soften up across a broad array of data. So, that comment yesterday was a big surprise to me.
Interesting. David, good to catch up, to get your view on things. David Rosenberg Research founder and chief economist. Tom, the old saying, the biggest solution to higher prices, sometimes higher prices.
Oh, yeah, absolutely. No, we hear that from a lot of good guests, and it's unfortunately played out time and time again. Lumber's the poster child right now, John, but I really take issue with the simplistic view of looking at gross inflation data. Rosenberg at Merrill Lynch invented the parsing of inflation. John, on page 7 of his report, he used to break out, for radio, I'm showing this as
That's
a
beautiful,
page,
Tom.
line by line,
Give
30
them a sound
and 40
effect, too.
items.
Nice.
There you
nice.
go. Well, the tank's kicking in.
Good tell.
John, I just think the parsing of inflation is what's necessary now, whether it's Carl Riccadonna or David Rosenberg, Ed Hyman the other day, the rest of them, they're on one page, and the inflationistas are on the other page.
Some guy called David Gura of NPR asked a nice question yesterday.
He was rude.
On Transitory,
I don't think Gura's got a chance of going to Jackson
A price
Hole.
level shift that doesn't leave a permanent mark on the inflation process. We can talk about that line a little bit later when we're joined by some guy called Luke Cower.
I mean, why can't we have
I wonder
beards?
if some guy called Luke Cower has a beard too, Tom.
Yeah, he probably
UBS
does.
Asset Management Asset Allocation Strategist will be joining us a little bit later this
I need a
morning
beard.
from New York. I've seen your beard. Tom, it looks good.
Thank you.
Well, you don't shave after a vacation. Keep it that way. Up 8 on the S&P 500, advancing 0.2% from New York. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. The US senators voted to move ahead with the infrastructure package. That happened just hours after a bipartisan group of senators and President Biden reached an agreement on a $550 spending plan. Lawmakers expect the final passage to last into the weekend and possibly even next week. Fed Chair Jerome Powell says there is still some way to go before the Fed starts reducing massive support for the US economy. Powell spoke to reporters after Fed policymakers kept interest rates near zero. They also maintained their bond buying program. It's one of the most anticipated listings this year. Robinhood raised $2.1 billion in an IPO priced at the low end of the marketed range. That gives the trading app company a marketed value of just under $32 billion. Robinhood shares began trading today. A surprise from Bloomberg analysis on vaccinations in the US. Some of the most vaccine-resistant parts of the country are now leading the way in the number of people getting a first dose. The increase in vaccinations is concentrated in the southern and central parts of the US. Credit Suisse reported a bigger than expected drop in second quarter profit. Net income tumbled 78% from a year ago. The aftershocks of the scandals involving Archegos Capital and Greensill are being felt in Credit Suisse's investment bank and wealth management businesses. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
We've shown America tonight that we can work together, that we can put aside ideological differences.
We're touching every element of infrastructure. If you're on the rails, if you're in a car, if you're basically wanting to get on the internet, your bridges and your roads, everything, the airports, we've touched everything here.
This time, we're going to get it done. We took a first important step tonight.
We're making some progress. Senators Susan Collins of Maine, Joe Manchin of West Virginia, and Rob Portman of Ohio. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Here's the price action. This Thursday morning, futures advance 9 points higher on the S&P 500. We're positive 0.2%. Yields are higher by 3 basis points to 126.59. And speaking of something that's up higher, stronger, take a look at Didi Global in the pre-market, up by 35.8%. And back to 12. Back to 12 in the pre-market. The IPO price was 14. That big move off the back of this report from Dow Jones, quote, ride-hailing giant Didi Global, I'll get there, Tom, then you can throw in some snark, is considering going private in order to placate authorities in China and compensate investors for losses incurred since the company listed in the US in late June. Tom Keene, the floor is yours.
Do the Western banks provide advisory services on this privatization?
Well, that would be interesting, wouldn't it, after they help this company go public
I'm just
in
asking.
this country? I think it's a legitimate question, Tom.
Just
And we're on the
asking.
same page on this one.
We'll continue to follow this team
look forward
coverage
to
on
that
Bloomberg
coverage.
surveillance on whatever's going on with capitalism in China. Seriously, renminbi does the right thing and what they want, some real stability, 6.46 yuan per dollar. Anne-Marie Horton doesn't care about the yuan. She's just trying to get 4 consecutive hours of sleep and joins us this morning on infrastructure. I noticed in the wonderful work at the Washington Post, Anne-Marie, you know, the summary there, excuse me, that they did today on this infrastructure bill. Tony Rowe, I'm doing this. I guess some of it goes to bridges, some of it goes to this, that, and the other thing. Are the people that just want the bridges, the roads, the tunnels, traditional infrastructure, are they happy with this first step?
It does seem like they are, Tom. I mean, you had 17 Republicans backing this first procedural step, including Senate Minority Leader Mitch McConnell, as well as Senator Lindsey Graham. So that does give a little bit of sense of the direction of travel of this legislation, that it is moving in a positive direction. We should note, though, we only know based on what is in this bill due to a Republican memo as well as from the White House. We don't actually have the legislative text yet. And there's going to be a few hurdles ahead, especially when it comes to amendments, potentially from Democrats regarding transit and as well as the amount of money that is going to water infrastructure.
Anne-Marie, I keep hearing this number, 1 trillion being thrown around. 550 is the actual number. So let's talk about the 550 and over what time period that money will be deployed. Is it actually a big bill?
That's a very good point, and it goes to what you're hearing from a lot of analysts on Wall Street when you hear the Republicans saying that they are so worried about fiscal spending, both packages, the bipartisan infrastructure as well as the soft infrastructure, that actually it's not a lot of money because it's going to be done over a short period of time. It's not like this $500 billion is going to be hitting the market instantaneously. So it will be done over a long period of time, which is a very good point, Jonathan. And a lot of people are saying it's a lot bigger than it is. But these are just pay-fors. They're just moving some money around, including some of that leftover COVID money.
Anne-Marie, people are looking, though, at the $3.5 trillion follow-on that's going to be passed in reconciliation, at least if Democrats have their way. This is the way to placate some of the more liberal members of the Democratic wing who are pushing back and saying this just isn't enough and that they want to push Biden's social agenda. What is the sort of procedure here in terms of the $550 billion plan really meaning that it's a go for the $3.5 trillion follow-on?
It's a very good question because this really comes down to that line in the sand we saw from Speaker Pelosi saying that the House will not take up the bipartisan infrastructure agreement until the Senate moves on the wider reconciliation budget package. Now, Senator Bernie Sanders says he has the 50 votes to get that reconciliation, a framework of that reconciliation budget package on the floor. I bring you to Senator Kyrsten Sinema, who is pivotal when getting done the infrastructure agreement. She says that $3.5 trillion is just too high. And remember, for that $3.5 trillion to get through the Senate, she has to be on board. So it's going to be very interesting in regards to the debate that is going to start surrounding that reconciliation package, what's in it and how much it should be.
What happens today?
Today, Tom, is a critical day in terms of COVID. We have the president expected to announce this mandate regarding vaccines for federal workers. And if you're not vaccinated, you have to mask up, socially distance, et cetera. So it's going to be a really important day at the White House when he makes this announcement and assessment on where the country is going in terms of vaccinations and COVID. We should note this administration has still yet to reach that threshold they wanted, which is 70% of Americans getting their first shot by July 4th. We're still at some 69%. So a lot of work still needs to be done, and the federal government wants to make it mandatory.
Tom, do you think the federal shift in the last week, at the federal level and actually at the local level as well, do you think that's given some cover to the likes of Alphabet to push forward and do what they're doing?
Yes, absolutely. There's a clear tone that we can't fix this, let private enterprise fix it. And the Google announcement yesterday was really, really important. I heard that from all sorts of sources, that it was a massive symbol to large and complex companies that they can go it alone.
Anne-Marie, just quickly, have you heard anything about this in Washington, whether the administration is working with some of these large multinational companies, the big employers, to follow suit, to do the same thing?
Facebook as well yesterday saying all U.S. workers need to get vaccinated. I agree that that does give some political cover. I haven't heard anything that they're working directly, but I would not be surprised. The direction of travel is certainly moving towards private institutions, private companies, institutions like University of Indiana. They are getting political cover if the U.S. government is coming out and saying, we want all of our workers to get vaccinated.
And this is where it gets tricky if you don't have a good relationship with private business. Anne-Marie, thank you, down in Washington, D.C. I'm thinking of a man here in New York City that doesn't have the greatest relationship, Lisa, with private businesses.
Yeah, indeed. I just want to, though, follow on the idea of private versus government cover to make these moves. Part of it is also that they don't know how to reopen their offices, private corporations, given the fluctuations in the Delta variant. I mean, Twitter basically closed its newly reopened San Francisco office in response to the Delta variant, some of these guidance measures that the U.S. Is giving out. So I do think that some of it is just given to them as the necessity if they want to get people back to work when people go back to school in September.
Alphabet, Twitter, and others delaying that reopening, that return to office, Tom. You wonder if Wall Street starts to follow. There's been an aggressive pitch here on Wall Street by several of the big names, several of the big banks. You wonder if they back away from that.
John, I would suggest it is Thursday into Friday in a summer. A lot of people, 3 days, 4 days, even weeks off next week. There's going to be a lot of meetings taken today on this issue.
September is a very interesting time. Lisa, you mentioned the return to school. That's critical.
Yeah. Did you see that New York City is now paying people $100 to get vaccinated? And so, of course, the conversation is, can you get vaccinated again?
What do you think the rest of the world thinks about that? The fact that New York City is paying people $100 to get vaccinated.
Well, they struggle to get enough vaccine to meet the demand. Yeah, I think that that's an interesting public relations issue.
Unbelievable. Tom Keene, Lisa Abramowicz, Jonathan Ferro. Your equity market looks like this on the S&P up 9, advancing 0.2%. Yields are higher by 3 basis points to 126.59. For our audience worldwide, this is Bloomberg Surveillance. Live from New York City for our audience worldwide this Thursday morning. Good morning. Here is the price action. In the equity market this Thursday, we're positive 0.2% on the S&P. We're negative about 0.1% on the Nasdaq, and we're positive almost 1 full percentage point on the Russell. It is a do no harm week for policymakers in the Federal Reserve and in China too. I'll get to that story now. Switch up the board and get to the bond market. 127.63 is where we closed on 10s last Friday. This is where we are right now. 126.76. And if you look at the week, it's as if that Fed meeting never happened. Yields, 126.76 on 10s, Tom. 191.43 on 30s. Yields higher there by 3 basis points or so. Same is true in the FX market for dollar China. It is a do no harm week for Chinese authorities. As Lisa pointed out a little bit earlier in the program, China convening the plunge protection team, it seems. What happened to dollar China?
Right.
Switch up the board and get to dollar China. The Chinese currency stronger. And this move, Tom,
my word,
the biggest move we've seen actually since January. Dollar China, 645.83. Nothing's entertaining you this morning, is it, Tom?
No, what's entertaining me is John Folks has a team of about 20 people to get him to real yield on Friday. And John, what I would recalibrate on real yield off of that huge move we saw off Chairman Powell yesterday is not so much the nominal yield, but the inflation estimate that gets you to the residual, that real yield. And if you listen to David Rosenberg, that inflation residual is going to come in with a vengeance, and you're going to have a real yield that recovers.
Just to be clear here, are you calling that a huge move yesterday? Is that what you just did?
I think it was substantial. I think we went out to record negative statistics on real yield. I don't think enough has been said about it.
We can do that now if you want. Do you want to carry on?
No, I'd like to carry on, but you're going to go into planning with your team on the real yield, and
what did you expect?
Is this the editorial meeting now?
No.
Is this it?
You've got your team to.
I think our audience would like us to continue, Tom, with the show, if you want to.
Yeah, well, kids, I can go either way. Jack Ablin's like, what am I doing here? Jack Ablin joins us with Crescent Capital, our Chief Investment Officer. What does the real yield signal, oh, wise one? Jack Ablin, there it was spiking out to record negative yields yesterday. Is it a so what?
Well, apparently for the Fed it is. There's obviously no incentive for the Fed to do anything. Record negative real yields suggest that financial assets, if left alone, will deliver, negative purchasing power. And so one of the themes that we've been playing was a shift out of financial assets into real assets. And, our allocation is added to gold over the last year or so.
Where's gold here at 1,800? I mean, is it linked to all that's going on, or is it a beast of its own?
Well, I mean, the fact that, it just treads sideways at around 1,800 is not a bad thing. We're not looking for it to beat equities. We're looking for it to really just maintain purchasing power over time. So I'm viewing it as more of a cash alternative. And, if it creeps higher with prices, that's great. Because certainly someone locking in, a 1.2% 10-year yield is doomed to fall behind the standard of living.
They said that at 150 then, and then we rallied, Jack. And I just wondered, does it provide any buffer in the portfolio to have that 10-year, to have that Treasury mix in there?
Yeah, I mean, I think it does. I mean, we're using bonds as really an expensive luxury to just match cash flows. It's the only asset class besides maybe lottery winnings that can offer you a specific dollar amount on a specific date. So when we're trying to match cash flows for our clients' spending, bonds are there. But beyond that, I don't view it as much of a buffer. It just isn't much yield to do that with.
Lisa, we came into this year and there was a huge conversation about the 60-40 portfolio, and there was a massive question mark above it. I wonder what that conversation sounds like now.
I love the idea of bonds as a luxury asset class, this idea that you're just having the luxury of basically earning a little bit less than perhaps nothing. But you know what? Honestly, the negative real yield, going to Tom's point, John, does raise a question. What are savers earning at this point based on the real inflation rate? The least ever.
Not much at all. And Tina is ringing in my ears now. Jack, Tina, there is no alternative. Is that all this is about now in this equity market? Go on, Jack.
Yeah, I think there is. I mean, this been the theme of financial repression for now the decade. It's just really coming to a head. I think what are some of the implications are, the fact, we talked about the Fed put, forget it. I'm not sure unless they want to start buying equities or, putting on cheerleader outfits. I'm not sure that the Fed's going to stand by. So I think they're long-term equity investors facing an equity market at record valuations need to understand that if we do get a downturn, not sure where the circuit breakers kick in.
I want to jump in with a stock move, Jack. I want to get to Didi Global in the pre-market, now up just 13.75%, up by 12% now, Tom. The roulette continues. It's a break of 10. We need the chart here. If you can get the chart pre-market, that's what we want to see right now. So I can show you the surge and then show you the rollover off the back of Didi saying the rumor that it could go private is not true. That's according to Reuters. And Tom, just to frame this for people that have just tuned in, the big move came from a Dow Jones story that read as follows. Ride-hailing giant Didi Global is considering going private in order to placate authorities in China and compensate investors for losses incurred since the company listed in the US in late June. So it's Dow Jones on the one side, Tom, Reuters on the other, and this stock is now just at about 10, positive 13%.
We are honored that people like Jack Ablin watch us each and every day. We've got a huge global audience of Global Wall Street. This is a window into what we do every day. It's not just John, Lisa, and me, folks. This is about, we cite the news where it comes from. In this case, as John mentions, Dow Jones states up we go. And then Reuters comes out and says, maybe not. What you don't hear or see is what's in between, where people like Martin Schenker and Kieran Buchanan are scrambling with all of our resources to look at these rumors and these speculations. And John, once again, our team has absolutely nailed this.
Jack, just looking at this story and how it's evolved over the last month, how investable are some of these names now, given what's playing out?
From a macro perspective, we don't think that Beijing is getting out of the capitalism business. I think that, they are certainly going after some of the larger players, particularly in tech. But I think that all in all, we're actually on the prospect of buying Didi at this point. We don't have it in our thematic portfolios. It just came out, but we're going to be adding it.
Jack, on a broader level, are you interested in buying Chinese shares in general, particularly the beaten-up education sector and some of the other areas? Because there is this buy-the-dip moment, and the Chinese authorities have shown that they are uncomfortable with too big of a sell-off?
Yeah, I think that there is a buying opportunity in China and emerging markets in general because of it. But, I'm more of a macro guy. I'm not going to come in and start picking individual names or sectors. I'd rather just play the general theme of China and allow that to play forward. So, yeah,
just to be clear, though, Jack, you did just say earlier, though, you guys would be looking to add Didi Global. What would that add for you?
Yeah, Didi Global is part of a much broader theme we call next generation transportation. It's a global thematic portfolio we have. It fit the parameters, and the fact that it was beaten up between June and now is, for us, a good thing.
Jack Ablin, Crescent Capital Chief Investment Officer
really valuable.
and founding partner. Thank you, sir. Just to frame this for our audience that might just be tuning in, I'll give you the information and you can do whatever you like with it. This is the stock move right now on Didi Global in the pre-market. It's positive a little more than 13%, pushing 14 percentage points higher to 10.12. The IPO price was 14. We had a surge earlier this morning off the back of a Dow Jones story that read, quote, in the lead paragraph, ride-hailing giant Didi Global is considering going private in order to placate authorities in China and compensate investors for losses incurred since the company listed in the US in late June. That's Dow Jones. Then Reuters out just moments ago, and the stock turns around on this headline, Tom. According to Reuters, Didi says the rumor that it could go private is not true.
My basic take here is to listen to Chinese authorities, whether it's Leland Miller, China Beige Book, the wonderful Elizabeth Economy at the Council on Foreign Affairs. And John, their basic take is, well, you know what? The government's in charge. The government's making the decisions here. I saw overnight somebody got an 18-year sentence, some executive in China. This is serious stuff.
It is, Tom.
With serious consequences.
And we're getting some commentary from the company itself on Weibo. So this is the official line from them. They say the privatization report is not true. They say it is not true. So look, that's what comes from the company. We've had the reporting from Dow Jones. This is the direct line from the company. More broadly, though, what Jack Ablin just said, I think is really, really important, that they're looking to buy that stock as part of a broader theme. And that is the risk at play here. For the people who have bought a basket of this stuff, and you see moves this big, you end up seeing other big moves in things like, say, Uber, Lisa, which is exactly what was happening with SoftBank yesterday. And this is the transmission risk, the contagion risk. This is how it builds. It starts isolated, and then it starts to bleed out because people buy this as a theme in a bucket, in a basket. part of an index, whatever it may be.
Especially as China becomes more mainstream in terms of indexing, in terms of its inclusion in stock portfolios. And this is one thing people were looking for. We didn't see a big note of contagion over the past week or so when some of the sell-off was really gaining steam. There is a question, Tom is talking about Chinese authorities and how they have been involved, and this really is their market. Yes. So the question is, how tolerant will they be of a sell-off? The fact that they are uncomfortable with how severe the sell-off has been is giving some people comfort. However, the balance of where their priorities are with respect to their society is still unclear in terms of how far they'll go with the capitalistic economy.
Do you think that changes things for investors? The next time a Chinese company, no idea when this is going to happen, but the next time a big Chinese company goes public in the United States, Tom, what's the attitude to that IPO going to be?
They'll make it up as they go. Good luck to them.
Has that shifted permanently now?
I got my own opinion on this that nobody cares about, but the answer is they'll make it up as they go, led by their Western bankers.
Didi, 1038. That stock is positive by a little more than 16%. Up next on the pandemic, Jennifer Nuzzo, Johns Hopkins Center for House Security Senior Scholar from New York. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. That $550 billion infrastructure passage has cleared its first barrier on Capitol Hill. The Senate voted to begin consideration of the bill. 17 Republicans joined all Senate Democrats and 2 independents in voting for the measure. Lawmakers expect the final passage to last into the weekend or possibly even next week. The new chair of the Federal Trade Commission is vowing to return to the agency's trust-busting roots. Lina Khan told reporters she intends to use the FTC's full arsenal to take on companies that are preventing competition. Khan also signaled she is not afraid to take on risky cases that officials have shied away from in the past. China may be preparing for a period of prolonged tension with Washington. Beijing's new ambassador to the U.S. is a veteran diplomat known for pushing back against Western criticism. Ching Chang most recently served as vice foreign minister. He told reporters he would work to put U.S.-Chinese relations back on track. Now, Royal Dutch Shell is stepping up its effort to win back investors. The energy company raised its dividend by 40% and said it will buy back $2 billion of shares. The move comes more than a year after Shell slashed its dividends by 2/3. And it's one of the most anticipated listings this year. Robinhood has raised $2.1 billion in an IPO priced at the low end of a marketed range. That gives the trading app company a market value of just under $32 billion. Robinhood shares do begin trading today. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
We are going to go for the full license, and the teams are working very hard to file a so-called BLA, biological license application. And we will do this over the next 2 to 3 months, before the end of the year for sure.
Pascal Soriot there, the AstraZeneca CEO from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Here's the equity market. The price action shaping up as follows this Thursday morning. Jobless claims out a little bit later this morning, 8:30 Eastern time. The S&P 500 positive 4, positive about 0.1%. Yields are higher by 3 or 4 basis points to 126.93. Let's call it 127. Euro dollar firmer, stronger by 0.25%, approaching 119 again, just creeping higher on the euro side of things. A stronger euro, Tom, 118.75.
John, and for radio, I have something new. I have a new look today, which is, John, I put in my pocket on the way to work today.
There we go.
A mask.
Had you not been using that in the Uber, Tom?
I've not been using that in the Bentley, and you know, it's just, you know, we got the shield.
I'm not sure that's in line with protocol,
right.
but carry on.
But you know, there's the mask. Jennifer Nuzzo joins us now to tell me when I'm going to put the mask on as well with Johns Hopkins. Jennifer, as simple as I can, I'm confused. Am I going to be less confused by Monday?
I hope so. We need to be less confused by Monday. But, you know, listen, I think there's been a lot of change in guidance, a lot of discussion about do we need masks now? But the fact remains, if you're fully vaccinated, you are still very well protected against the thing that we care most about, whether you get sick and that puts you in the hospital. If this virus couldn't do that, we wouldn't have heard of it. I have to keep reminding people of that larger picture there.
I'm just lost. I mean, yesterday was, John's clear on this. Lisa spent 3 hours yesterday studying this. What's the goal of the CDC on Thursday to get us to less confusion on Monday?
Well, supposedly one of the things that they're going to be doing is releasing more data on the what we apparently now know about breakthrough infections. They said that their new guidance that vaccinated people may, in some circumstances, need to return to masks, that's based on new science. We haven't actually seen the new science. We've known for a long time that it's possible that people who are fully vaccinated, that they can get infected and sick. But we always knew that the vaccines were protective against serious disease. That said, if you live in an area where there is a whole lot of disease and most of the people around you are not vaccinated, which those two things are probably linked, if you live in that area, you may want to wear a mask if you are the kind of person who never wants to get a cold. You may also want to wear a mask if you're someone who lives with someone who's really vulnerable, who, despite maybe also being vaccinated, is, the kind of person who we really worry about, people who are elderly or have underlying health conditions that may not give them the same level of protection from the vaccine that the rest of us have. Or I can imagine that some parents who are really worried about their unvaccinated kids might say, listen, it's not a big deal for me to wear a mask for a few more months until hopefully I can get my kids vaccinated.
Jennifer Nuzzo. That's exactly where I wanted to go. The question of children and the Delta variant. And there's been some mixed messages in terms of how sick they get from this variant. Anthony Fauci saying a small subset are getting very sick. We're seeing hospitalization rates in younger individuals creeping significantly higher. How dangerous is this variant for the youngest cohort that is not eligible for this vaccination yet?
So we have no evidence that this variant is particularly dangerous for young kids. It's just that when the number of cases go up, they go up in, proportionally in all age groups. And of course, kids, are many of them are too young to be vaccinated. So, they have additional risk than someone who is older enough to get vaccinated. But I think for parents, they shouldn't worry that this Delta is suddenly more deadly for kids. The risk of serious disease from infection in children is still extremely low. There unfortunately have been, a number of children who have had serious disease and a few hundred deaths, which of course is a tragedy. Most of these kids have had underlying health conditions. And so for that reason, I think parents aren't without worry, but I'd also want to give parents a little bit of ease that all the things that you've been doing for the last year and a half to protect your kids remain important. And, when and if vaccines become available for kids, that'll be another option.
Jennifer, do you think that this was a misstep by U.S. health authorities, that they really took the wrong approach here in shoring up credibility among the population?
Well, I think one of the challenges is that they had been saying that if you're fully vaccinated, you don't need to wear a mask. Now, of course, anytime the science changes, we have to update our guidelines. That's just good practice, and that's just how science works. I think the challenge is that we haven't seen what they're basing that guidance on, and that I think has raised more questions. But the overall premise that if you're a vaccinated person and you're living somewhere where the disease is raging around you, it is of course true that if you wear a mask, it will give you more protection.
Jennifer, where are we on the science hysteria meter? I know they have the meter in the labs at Johns Hopkins. The last 24 hours to me have been just absolutely nuts. I hear all sorts of innuendo. I hear adults like Adalja and Nuzzo and the rest of them, Hotez, all of you people killing yourselves on this. The essential workers, you guys must be just aghast at this. How much of this is science and how much of this is just flat out hysteria?
Well, you know where we are right now, the hysteria, everything that we're doing right now, all of this would go away if people got vaccinated. And that is really, I think, what's fueling it all, because that is why we're even having to talk about masks.
Would it, though, Doctor, given what we're seeing play out in Israel?
Yeah, absolutely. I think the cases in Israel are going to come down very shortly. We already see them coming down in the UK. So that's my hope that will happen to Israel. I also hope it'll happen to the United States. But I really want people to get vaccinated, because any additional cases, hospitalizations and deaths that occur when we have a tool on hand that can, prevent serious disease, that's just a tragedy. So let's avoid that.
Jennifer, thank you. It's good to get your view. Jennifer Nuzzo, Johns Hopkins Center for House Security, senior scholar. A lot of people, Tom, taking some comfort from the direction of travel in the UK at the moment, with cases rolling over, moving in the right direction
So,
again.
okay, where are we on this, John? Am I going to go to LHR here in the next couple of weeks? I mean, I talked to one of our fans, Al, who said he wants me there now.
You can fly to the UK very soon, I think, Tom, without quarantine. And you can fly directly back without quarantine. I can't join you, though. Maybe that's a good thing for you. Maybe you're happy with that, but you can go.
I'm sorry, I'm confused, folks. I mean, after yesterday, John, I got the mask here, and I don't know.
Well, I tried to clear that up yesterday, too. Tom, a lot of people are with you. I understand.
Is Apple going to make me wear a mask if I have to go in and buy Afterthought something today?
If you go into one of their stores, you will have to wear a mask again, yeah.
Why?
That's what they've decided.
Okay.
Would you like to speak to Tim Cook?
Yeah, well, we have an interview with him, I think, coming
to direct
up.
those questions at
I was
him
going to talk about free cash flow, but maybe we'll talk about the mask.
I think it's interesting that actually, if you look at the vaccination rates, which a lot of investors are doing in order for a leading indicator, you're seeing them tick up pretty significantly, particularly in ares that have been pretty hard hit by the Delta variant. So to me, I find this interesting that the best treatment, perhaps, to get people to get vaccinated is an increase in incidence.
There is a shift in this country in the last week. From New York City, alongside Tom Keene and Lisa Abramowicz.
That's the first thing you said well today.
Thank you, Tom. Thank you. 4 on the S&P. Such a great team, you and I.
We had Didi data check. I need more Didi here. I need more Didi.
Is this why they separate us?
You got that right. We're hermetically sealed.
It's a science experiment.
They should have seen it when it was just us on radio.
Oh, Lisa, you
before Lisa came in between us and we were throwing stuff at each other. The cameras weren't on us then. You've got to behave now from 30 feet away.
You spilled my tang.
Yeah. Luke Cower's next. Who's he? From New York, this is Bloomberg.
We've shown that if you give enough fiscal stimulus, you can get a strong economy.
Each central bank is trapped, and they're not going to be able to exit this unconventional monetary policy.
They're all using models that are traditional models, but this has been a very non-traditional recession.
Monetary policy cannot combat the major problem to the economy.
Having some cash to deploy and look opportunistically for sellouts is a good idea.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It's the day after the Fed and all is quiet. From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures up 7 on the S&P, advancing almost 0.2%, Tom. A snoozer of a Fed meeting for some people out there at least.
Very successful for Chairman Powell, there's no question about that. And I thought Michael McKee, that was his analysis as we ended the show yesterday. What I see, John, within the week of back and forth, and you frame the 10-year yield, where are we right now? 1.27%. What I would suggest, John, is we're sort of walking around with a VIX 25 gloom, some real, not like outright fear in that, but there's just some angst out there of VIX 25, and the VIX is actually at 17.70. Not all that bad.
Do you want some volatility, Tom?
Please.
Do you want me to go there? Didi Global. Let's go there. Let's frame this debate.
I think it's been minutes since we've looked at this.
On radio, Didi Global now positive by 16.9% after surging 40 percentage points off the back of a Dow Jones story that indicated the company was considering going private, and then the company itself, Tom, coming out and saying, no, that's not true. This stock has been all over the place, and it's been the poster child for what's been developing in Beijing.
It has been. I mean, I don't have a lot of wisdom to put in here, John, other than clearly, as I think Lisa mentioned in the last hour, Chinese authorities have stepped in the last 2 days and begun to rumble as government officials can do.
Yeah, and Lisa, that's certainly the broader story.
Yeah, and this is one thing that's giving people confidence that perhaps Chinese officials won't go too far with their regulatory measures to pare back some of the more aggressive tech areas. Again, though, it highlights how uncertain the field is for data. There is a fight for data. Chinese government officials want the control over it. They are concerned that the U.S. could have access to it. They are concerned about IPOs in the U.S. and, frankly, vice versa. And this is going to be a lasting theme, John.
And that story's going nowhere anytime soon. That is the issue at the moment. Here's the issue this morning. Not much to talk about. It's a snoozer in the equity market. Futures are up 6 on the S&P, up a little more than 1/10%. Yields are higher.
Oh,
we have a move there.
There
you go, Tom. Up 3 or 4 basis points. 126.76. Euro dollar 118.74. A stronger euro advancing, Lisa, 0.2. of 1%.
John, we got to stop the show. Can we
What,
just
on
state
euro dollar?
No, 6 months ago, 8 months ago, that 4,400 even print on SPX was unimaginable.
I agree with you. Year-end median right now, Tom, 4,300. From the strategists that we survey, that's the median now, year-end target, 4,300. And we're north of that already.
We heard a 5,000 number yesterday.
Still got to close out July. We put Scott Minerd on the spot, though, didn't we? Can't just throw out 5K. You need a time horizon. What did he say? Over the next 12 months or so, he can see us getting there.
He said or so, but still, you got Minerd saying 5,000. You know, I'm still triple leveraged all cash, but hey,
Thanks,
Minerd's
Tom.
at 5,000.
Lisa's waiting patiently. Let's get to Lisa
Lisa,
and run through the day ahead.
Do it all on Didi.
I'm drinking my Tang and really loving this. I will say, what we're looking for today could give a little bit more drama to the Fed meeting that we got yesterday. The idea here that jobless claims are really coming into focus. All jobs data, in my opinion, are taking on new significance after Fed Chair Powell said, we have not made significant further progress. We have made progress, not significant further progress. We're not there yet, and it is because of the jobs numbers. They want to see big headline prints. What kind of progress do we get? And does this mean that there's renewed volatility around some of the jobs information that we're getting? We're also going to be, of course, getting GDP reading expected to be about 8.5% on an annualized basis, a near record high. 1 p.m., the all-interesting 7-year note auction. The U.S. is planning to sell $62 billion of these notes. These tend to be a more volatile sale at this point, though, given the demand for bonds. Perhaps they, like the other auctions, will be snoozers. However, it will be interesting to see if perhaps this answers the question that even Fed Chair Jay Powell couldn't answer, which is why are bond yields so low? Why have they gone lower after the previous Fed meeting? He didn't say he had a clear answer on that except for technicals, which really is another word, as he said, for other things that you might not understand. After market, we get Amazon reporting second quarter earnings. This is the last of the big tech behemoths. Question mark about labor pressure from unions saying, please raise the wages. Pressure also on their cloud computing unit to see how much they are competing. And of course, going forward, any regulatory pressure like what we saw out of Facebook, and that could potentially curb their growth, which is why those shares are lower today in pre-market trading, John.
Lisa, thank you. Here's the quote from Chairman Powell on what has been happening with the bond market. He doesn't know. He says the following: I don't think there's a real consensus on what explains the move between the last meeting and this meeting. Tom, this is what he had to say on the labour market. Let's tee up jobless claims a little bit later. This is what he had to say early in the news conference. I'd say we have some ground to cover on the labour market side. I think we're some ways away from having a substantial progress towards the maximum employment goal. That was kind of the headline in the middle of the news conference, Tom.
It was. There was a shift later. We'll go to that later. But, John, you're absolutely right. And what's great about this debate, folks, is there's a chart that's crystal clear. We're not going to show it now, but there it is, John. Labor participation just isn't back to Valentine's Day, 2 years distant.
Let's get to Luke Cower on that, UBS asset management, asset allocation strategist and former Bloomberg cross-asset reporter. I don't remember him, though, Tom. I just know him from his UBS days. Luke, it's good to see you. You can have a dig back at Tom a little bit later. Let's get to this interview. I want to start with the Federal Reserve and this progress we want to make in the labour market. It's very dependent, highly dependent on how the supply side of this economy responds in the coming months, Luke. What are you and the team looking for?
Well, that supply response is one reason why the kind of sequencing that we need to see is still, as Powell says, a ways off. That, they've highlighted essentially September and Q4 as a time when labor supply might begin to be unlocked, so to speak. So if you're thinking about it from that perspective, well, you just don't get that September data until past September. So some of the more aggressive timelines for signaling the beginning of tapering and perhaps starting that, you have to again kind of push those back a little. And that's why it was pretty useful yesterday to have the ability to mark to market what are the things that are actually making the Fed more hawkish. Could be down the road. And the only thing they seem to agree on right now is that the labor market needs more healing. Inflation, they're all over the place.
Look, the only reason we let you go to UBS is you took 3 logins and 12 Bloomberg screens with you. And what you use them for is the correlations of the markets. Are these normal markets, are bonds, FX, all of them, and equities, are they correlated within the asset allocation model?
Well, certainly they're all correlated into varying extents. They're going to paint different pictures about the degree of cyclical strength or not. And right now, what we see in kind of reviewing cross-asset correlations is that on the downside, the assets that are signaling, perhaps less optimism about global growth than normal, than on average for this point in the cycle, it's clearly 10-year yields are the standout there. It's quite frankly not even close. And so there is a feeling that you do have to respect the bond market, and as Jay Powell said, he doesn't quite know, so I'm not going to have the hubris to try and define a clear answer there. But you have to respect the bond market, but you can't write it off on the one hand, but on the other hand, you can't let it be the sole author of your asset allocation and what you're seeing out there. So what we do see out there is still a fair degree of cyclical strength in things like commodities and in just overall equity prices, and a lot of what you're getting from corporate guidance that does paint a very different picture about the economy we're going to have over the next 6, 12, 18 months than what the bond market is currently signaling.
So what has your change been to the asset allocation recommendation following this earnings season as we wrap it up with the end of big tech earnings with Amazon later today?
So I would say that there's been no immediate changes, so to speak, regarding asset allocation, but a few themes have stuck out that really do paint just this stark contrast between what executives are telling us and what the bond market is telling us. Because the bond market is essentially telling us we have a very short window for growth before the Fed crushes both right tail inflation outcomes and right tail growth outcomes. And then executives are meanwhile telling us that we seemingly have a pretty long runway for above trend activity to continue. And I would say the biggest thing where we see this, and you might start to get hints of this in the GDP report released later this morning, is just the inventory rebuild process. This is going to be absolutely massive and persistent, and essentially shortages are what are paving the way for having a longer runway for growth, essentially because you need to make the capex to unlock more production downstream. You need more production downstream to meet current demand, and then also to rebuild inventories. And all companies are saying is that we need to do this, but we understand that this is just going to take a very long time. It's so interesting to see companies that have rebuilt inventories to a certain extent are saying that this is our competitive advantage. This is our way we can keep and grow market share and top line, not building inventories as a sign of flagging end demand. So that's something that it inspires a lot of confidence that some of our views on cyclical sectors, whether that be energy or financials or more cyclically oriented markets like Europe, that those are what are going to lead as we move from kind of pricing in this peak growth environment, these kind of quasi fears about how much Delta will delay the full normalization to activity, to what kind of run rate do we settle to on the other side. And that's going to be a pretty strong run rate. We think it's going to be far superior to what we had the early years coming out of the financial crisis.
Luke, final question. How would you characterize your current situation? Are you a happy Manchester United fan or an unhappy Yankees fan? Which one is it?
I'm still a depressed Toronto Maple Leafs fan, first and foremost.
Toronto Maple Leafs fan.
Yeah, but happy about Sancho and Varane.
Tom?
Very happy.
Is that basketball, Tom?
Can we just point out that he has an American flag behind him?
Is that American football, Tom? No?
No.
They don't know?
It's hockey.
Hockey. Okay.
It's
Luke
painful.
Cower, UBS Asset Management, Asset Allocation Strategist. Luke, thank you. Tom, you okay? You're a bit disappointed after the Fed decision yesterday, the news conference.
I think it's...
Did you not get what you wanted out of it?
I got what frankly, I thought it was a pretty successful meeting. I thought, to be honest, Chairman Powell started out shaky and he improved as the meeting went through.
He did. He pulled it together slowly, didn't he?
Yeah.
Nice. All right. Up 7 on the S&P. I'll get to the bottom of this. We'll work out what's wrong. Equities up by 0.15%. Yields up by 3, 126.76. You've got a long weekend as well, haven't you?
I'm taking off tomorrow just to get ready for Ted Lasso.
So I'm just wondering what's wrong.
You haven't watched Ted Lasso yet.
Things.
How can we, John?
I'll watch it.
You've got to watch the first
Tom,
season.
I'll watch it for you. The S&P up 7. It's going to be okay. We're up 0.2%. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. The US Senate has voted to move ahead with that infrastructure package. That happened just hours after a bipartisan group of senators and President Biden reached an agreement on a $550 billion spending plan. Lawmakers expect the final passage to last into the weekend and possibly even next week. Now, Fed Chair Jerome Powell says there's still some way to go before the Fed starts reducing massive support for the US economy. Powell spoke to reporters reporters after Fed policymakers kept interest rates near zero. They also maintained their bond buying program. The coronavirus surge is hampering corporate America's plans to get back to normal. Google says it will push back its official office return to mid-October. Plus, workers at its campus will be required to be vaccinated. Lyft is postponing its return date to February. Meanwhile, masks are now required at most of Apple's stores over in the US. Didi Global is denying a report that it is considering going private. Dow Jones said the ride-hailing giant may go private in order to appease Chinese authorities who have cracked down on the tech sector. The report sent the stock soaring in pre-market trading. Before today, shares of Didi were down 37% since it listed on the New York Stock Exchange back in June the 30th. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
The committee continued to discuss the progress made toward our goals since the committee adopted its asset purchase guidance last December. We also reviewed some considerations around how our asset purchases might be adjusted, including their pace and composition, once economic conditions warrant a change.
Fed Chair Jay Powell there from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Here's the price action in your equity market. A quiet one for the S&P. Futures basically unchanged through much of this morning. Positive 0.2%, up 8 points so far this morning. Outside of that, into the bond market, yields are higher by 3 basis points to 126.43. Tom, euro stronger, approaching 119 again at 118.74. Euro dollar positive 0.24%. And crude, WTI, 72.65, advancing 0.4%.
Two items, John. Dollar weakness, 92.04 on the vanilla DXY, the big nation DXY. And, John, a 91 handle there, I think, would be of note. And the other is we haven't mentioned Amazon. We've got important earnings.
A little bit later. And just quickly, Tom, a headline on Citi, reinstating the mask requirement in offices after the CDC update. So one of the updates from one of the banks. And Tom, I do wonder who's going to follow here. Not on the mask mandate, not on that stuff, because that's not being something that they can actually decide on. It's the things that they do have a little bit of flexibility on. Return to office plans. I wonder how flexible they'll be about that and whether that gets pushed out a little bit more.
We've seen it already, and I agree with you. And John, what I would, if I'm a business, John, I want to get this fixed now. So now is Thursday and Friday.
Well, I'm a business. I'm taking the CDC requirements, Tom. I'm working out what on earth they mean because some people are still struggling with that.
Jennifer Nuzzo doesn't know.
And then I'm looking to apply that. And I agree with you, Tom. Many companies around this country, they just don't know. They're still trying to work that out. Where they do have flexibility is return to office, return to work, return to the city. I wonder what the messaging sounds like through the summer now, through August and into September.
Quickly, John, is it the same in London?
In terms of what, Tom? The mask mandate?
Confusion, just confusion.
No, I think things are just opening up. As you were in London. Not much has changed as those cases really built up. Boris Johnson, the Prime Minister, looking forward and pushing on. And the cases are starting to move in the right direction. That's good.
No, not much has changed in Washington either. Jack Fitzpatrick drives forward the conversation from Anne-Marie Horton in the previous hour. Jack, I guess you had an 18-hour yesterday. What does your day look like today? How can somebody vote against bridges and tunnels?
Well, it's an expensive proposition. This is a $550 billion measure, so you're going to get some Republicans opposing it. But they got 67 votes in favor of the procedural vote yesterday. So really today and the next few days, it's unclear when we're going to see the text. I don't think they have to file the text and put out every detail until at least Friday. But today and the next couple of days, they'll run that by everybody they can run it by in the Senate, make sure everybody who is okay with that first procedural vote is actually planning to vote on passage and really just trying to wrap up the loose ends. But it does look like this deal is a real deal, and they're just really turning the bullet points into legislative text and going through all those mechanisms of taking the procedural votes.
To Friday, to the Sunday talk shows. Let's even go to Monday morning. Will various and sundry senators know which projects are in that bill?
Probably not. In the near future, I don't think it's going to be very clear. There's a process of earmarking money through authorization bills. So there are some lawmakers who feel confident they'll get funding for particular things they want. But a lot of the money that has been negotiated for this bill is based on formulas. And so then it goes to the executive branch. The executive branch has to figure out the absolute specifics. So what they've been talking about lately is the amounts. How much goes to highways, how much goes to transit. Not every lawmaker, I would guess probably most lawmakers don't know exactly yet how that's going to affect their constituents and might not know for a little while. A lot of this money doesn't go out for a number of years. This is sort of an 8 or the better part of a decade spending plan. So there's still uncertainty in terms of how the politics works for this person's district versus that person's district.
Jack, where is the biggest pushback likely to come from, Republicans or progressive Democrats?
It depends on how it's tied to this next bill. There are Republicans who don't like that this infrastructure bill that Republicans are supposed to like is tied to a $3.5 trillion measure. There are progressives, though, who might not want to vote for this if they think that that next measure is in danger. So it's coming from both sides ideologically for different reasons, because both sides have complaints about how this has or hasn't been tied sufficiently to the next big bill. I know that's a complicated answer, but that's really the challenge going forward is they can't pass this with enough Democrats unless the Democrats get their bill. But the fact that the Democrats are doing that is not popular among Republicans. So there are issues on both ends of this.
It's maybe a complicated answer, but it's exactly where people's minds are. This isn't just a $550 billion plan. This is really a $4.1 trillion package, including the reconciliation bill that I believe Bernie Sanders is working on. Is Senator Sanders close to finishing or releasing bits of what that plan looks like?
Yeah, in the near future, we should see them move ahead with the basic framework. The way they pass these partisan measures without Republican support in the Senate is basically a two-step process. You put out a budget resolution with the basic numbers of what committees are supposed to work on, and then later when they get that bill out itself, you have to vote on the bill as well. So before they leave for their recess at the end of next week, they want to not only have passed this infrastructure bill, but also voted on that budget portion, that first measure to set the stage for that later $3.5 trillion bill. It'll take a while to actually pass a $3.5 trillion bill, but in the near future, the plan for Democrats is to take the vote to set the stage, make sure they can get a majority to vote for that, and get things moving on the even bigger bill.
Jack, thank you, sir. Good to catch up. Bloomberg government reporter down in Washington, D.C. Headline in the last couple of minutes, the masks are back at Citigroup. This from Jenny Saran of the Bloomberg finance team. Citigroup has gone back to requiring employees, regardless of their vaccination status, to don masks when they're in the office. That according to a person familiar with the matter and in line with some of the advisory coming from the CDC this week, Tom.
Well, yeah. I mean, I'm practicing. Is this where
nice.
we're going?
That looks good on you.
It looks good on me.
That is a good look.
I mean, are we ready for this, John? Seriously, is this nation ready for this?
I wonder to what degree this is going to spread, Tom.
I mean,
and I'm not talking about COVID.
Joke.
I'm talking about the decisions. Some companies wait for the advice to come from the CDC. Other companies try and get ahead of it, and they institute even more stringent controls. I think the more important conversation to have away from the masks are the vaccine requirements that we're starting to see come from the federal government and elsewhere and from private organizations in this country.
Lisa, when's the school debate click in? I'm guessing August 10.
I think it's clicking in right now. When do you start mandating vaccinations? And frankly, it really clicks in when you get children under the age of 12 eligible for the vaccine.
That would be quite a headline if you start to see that date pushed back for the return to school.
Yeah.
I'd be interested to see how this market responded to that. Your equity market right now at 5, advancing a little more than 0.1% on TV, on radio. This is Bloomberg Surveillance. Live from New York City for our audience worldwide on TV and radio, good morning. Here is the Thursday morning price action. In the equity market, on the S&P, positive a little more than 0.1%. On the Nasdaq, negative 0.2. Some outperformance again on the Russell to small caps, up 0.9%. Let's frame the week. The debate started with Goldman Sachs and the team over at Goldman with Jan Hansius leading the way. To what degree, to what extent has a full service sector recovery been delayed? And what does it mean for the economy? What does it mean for this market? So let's work through it together. In the bond market, switch up the board, 2s, 10s and 30s. Your 10-year right now, 125.59. I don't know why we're down here. There's no consensus on why we're down here. Chairman Powell doesn't know why we're down here. But let me tell you, if we don't get that supply-side response in this economy anytime soon, it's going to get much, much harder to call this bond market and to call this labour market. And Tom, that's where I want to finish. In the labour market, switch up the board and get to the employment to population ratio in America. You can take a chart of this. You can take a chart of the participation rate. You will have a gap lower. You will have a little bit of improvement, and then it will stall. And Tom, what we need to see in this country is a supply-side response on several fronts. And what many people anticipated is for that to start to develop in September and heal as the year grows older. The issue people have now, Tom, given the developments on the COVID side of things, has that been delayed? And to what degree?
And on radio, all you need to know is we're 60% back to where we were. John, I'd suggest 7 million jobs. I think time has to move on, John. All of this has happened very quickly, and the real COVID setback that we've got right now, we're all impatient for Q2 of next year.
We need time, Tom, but it's not a demand problem, is it?
No.
So what's the Fed's role in all of this?
That's open to debate.
That's going to be the interesting conversation for the next several meetings. What is their role in all of this? And is the taper debate, is that exclusive? Is that the same story as what's happening in this? I don't think it is.
Yeah, my enthusiasm for the private enterprise of America, from the big companies like Amazon right on down to small businesses, John, that's what I'd focus on.
Just pushing things out, just a little bit.
Just pushing
And
it out
Lisa's right to keep bringing up the school issue as well, because September is absolutely crucial. Some of the things we're talking about through the week, we'll keep talking about them through this programme. Let's get you some movers and bring in Romain. Hey, Romain.
Hey, good morning, John. Let's focus in on the transportation sector this morning here. Uber shares taking a leg down. Of course, that report out of Bloomberg that SoftBank is actually shopping $2 billion worth of shares over at Goldman Sachs between 44 and 46 bucks a share. That report is out of Bloomberg. There's a separate report by one of our competitors over at CNBC saying that they were specifically shopping those shares to cover losses on Didi. Of course, we know Didi shares were down about 50% prior to the last couple of days. Those shares did rally to 10% yesterday, and they're up about 17% here in the pre-market. Of course, on another Bloomberg report saying that that company might be considering going private. Didi saying that's not true, but nevertheless, some of the dip buyers jumping in here just in case here. Also in the transportation sector, a completely different story, and that's Ford. We did get earnings out of the company last night. They were pretty good here. A surprise profit. The concern here is they are losing market share. Market share in the U.S. right now down below 11%. Remember, it was at about 15% a year ago. But Tom, they got a huge pipeline coming. All those electric vehicles I know you had your eye on, an electric Ford Mustang, an electric, the F-150 Lightning. All that is in the pipeline, and the company saying some of the supply chain issues, they're working through it. Don't worry, those 2022 models, they will be on the lot sometime this year. You might be able to get your hands on one, Tom. Flip up the board here, just a couple other quick names that I want to take you through here. Let's look at Qualcomm here. We did get those results. The company saying that it is also dealing with those supply chain issues, and it's managing to diversify away from just the smartphones. Remember, this is a company that has really sort of risen and fallen based on the smartphone cycle. It said it's managed to move into consumer electronics, a lot of networking gear. Investors seem to like what they hear. They did not like what they heard out of Facebook yesterday. Despite 56% revenue growth and a doubling in net income, that company saying that's not going to last. It cited regulatory headwinds and, of course, those new restrictions by Apple on its platform to restrict how data is collected. Those shares down 3.5%. Those were all the big stories over the last 12 hours. In about 8 hours or so, we are going to get Amazon, of course, the big granddaddy out there, fourth largest company in the world, knocking on the door right now of a $2 trillion market cap. Stay tuned for that later tonight, Tom.
Romain, thank you so much. John Farrell, the movers with Romain Bostic. John, is Harry Kane a mover? I still can't figure it out.
Don't know yet, Tom.
Is he going to leave from the Tots and go someplace else?
I think that would be the big signing of the transfer window for Spurs if they hold on to him. Do you want the real breaking news? Just to reiterate, Tom and I don't drive. Tom and I don't drive.
That's breaking news.
There's only one person on this team that drives, and it's Lisa.
Yeah,
correct.
It's not Tom and me.
Yeah, I don't know how else you would get up to Tupper Lake.
Exactly.
We'll have to discuss that.
I know. We need to work this out. What we're waiting for, Lisa, is that fully autonomous driving vehicle to come along and just
I
pick
don't
us
buy
up.
it. Oh, John, I don't.
Just
You're
pick us up.
going to get
And
me
I'll have a
going, John.
subscription.
Fully
We'll have a
autonomous
subscription, Tom.
I saw a
Just
Tesla
press the
article
button
the
and
other
it just
John.
rolls up.
I saw a Tesla article the other day that the auto driving thing got screwed up because of a yellow traffic light.
Really?
Yeah, seriously.
Yeah, that's not good.
That's not
We need
good.
some progress, Tom.
Guys,
Here's
then we
what's
can have a
good.
subscription.
It's not that hard to drive.
David Rosenberg
Don't
with us the
ruin it.
last hour. Let's keep
Gonna
going.
wait. Be
David
patient.
Rosenberg. My word, you sounded like Tom Keene. David Rosenberg, the last hour. Michael Schumacher joins now, and he is Cornell Big Red, and he knows Liner Rink is where they play good hockey, and he throws it into his note this morning. Michael Schumacher, long ago and far away, there was a CCM 5-stripe. That's a stick the rich kids had, and you say this is a yield that's going to look like a CCM 5-stripe hockey stick. Discuss that, the Nirvana out to a higher yield.
Yeah, Tom, especially when you consider the idea of real yields in the U.S. being minus 115, 120, some crazy number in 10 years, it makes very little sense. Real yields at this negative level are remarkably unusual. It's happened only a couple times. The last time was just before the taper tantrum. And you've got to ask yourself, what is the economic backdrop today versus 12 months ago? Substantially better. We can talk about COVID case counts going up recently, et cetera, but still, it's pretty hard to dispute that things look a lot better now than they did then. Yet yields are much more negative in real space. And we think this is a bit crazy, frankly. So when you've got high inflation, it should push up nominal yields. Real yields probably follow suit. We think the stage is set for yields to climb. However, I've said that before on this show, and in the last couple times it's been wrong. So I think a little humility is in order. We think it's going to take a while, probably 3 to 4 months for this move to get in train. I think it's probably a November, December type of scenario.
To understand why they're going to go higher, Mike, I need to understand why they went lower in the first place. Why did they, Mike?
Yeah, a bunch of things came together, John. And in fact, yesterday is a good example. So why did yields drop in the last hour or two of trading yesterday? Well, one of these arcane things, we think it was tips investors adding duration before month end, which is tomorrow. So not the sort of thing you necessarily tie to a Fed meeting, but it did crop up. But I suspect the bigger thing, going back to the June Fed meeting, is the Fed really gave the green light for people. They said, look, we're not going to do anything for a while. We'll sit here, maybe we'll put a mention of taper in the statement, that sort of thing, but we won't actually really change policy for quite some time. So a lot of investors out there look at the yield backdrop and say, well, it's super low. I have to do something. I've got to pick up a few pennies in front of the steamroller. What can I do? I can move out. I can buy longer maturity, longer duration bonds. Maybe I can sell some options, that sort of thing. But the Fed really put that back in play in June. And we think that was perhaps the big driver. On top of that, you've got overseas flows, which have been pretty strong.
Mike, one thing that always confuses me and I'm a little bit uncomfortable with is when people take the price of the bond market and say, this is what the market is looking for, inflation at X% over whatever time period. Mike, I'm uncomfortable with that because some people buy inflation protection, not with conviction, but as a hedge. And I just wonder, Mike, whether we misread what markets are actually telling us behind the motives of the people making these decisions.
I think another way to consider that, John, is does the inflation market that we trade, so tips, swaps, et cetera, is that really predictive of future inflation? I would say not very well. I think you make a good point that quite a few investors and other players out there buy inflation protection because they need to, not because they want to. It's probably the case again. But still, in terms of short-term market dynamics, it can have a fairly big effect. I think another way, too, to consider this question is, do forward rates in nominals really predict future actual yields? And the answer consistently from academic after academic has been no. And if we take that analysis today, the forward 10-year Treasury rate at year end is about 140. Does anyone really think that's a great predictor of where it'll be? I would say not.
So what do we have to see? What's the trigger to get real yields less negative, off their lowest levels ever seen?
At least I think a few things have to come together, probably even more strength out of the labor market. Thinking about some of the comments that Chair Powell made yesterday, very few specifics, a lot of generalities, but one theme that came through is more and more strength out of the labor market. There's been a lot of concern, speculation, hope perhaps that come September, maybe October, the labor market would be much stronger in the US than it has been. If that happens, that probably pushes yields up quite a bit. If instead we get a reaction where the COVID case counts have worsened, Delta seems to be becoming almost endemic. That scares a lot of people. That keeps yields pretty low. So I think the tipping point, my colleagues on the Wells Fargo economics team would share this view as well, is going out 2 to 3 months. Do you really get a break? Does that supply chain really start to move? Does the labor market clear up?
That's the key question, Mike, for everyone right now. Mike Schumacher, Wells Fargo Global Head of Macro Strategy. Your real yield on a 10-year, negative 117. And just briefly, Tom, after rolling over quite aggressively over the last couple of months, gold's starting to wake up just a little bit. Just a little bit. We're starting to see some movement in gold in a way that we didn't, say, going into June.
Up $30, $18.32. It is a little bit of a breakdown, and we heard from Jack Ablin from Chicago and Crescent, his affection for tangible assets. That would be gold.
Gold off the back of real yields, negative, Lisa, 117 on a 10-year.
It actually could make sense from the point of view, and just talking about negative real yields and how negative they are. I spent a lot of time yesterday thinking about this. And if the Fed's going to keep printing money, if they're basically going to keep injecting cash into the financial system after surging, after their balance sheets basically doubled since the beginning of 2020 to more than $8 trillion, you have to think, where is that money going? And if it can't go into things and services, it's going to go into assets. And a big asset, Treasuries. This is really it. And I think that I don't really see what's going to change that dynamic.
Tom?
The 5-year inflation-adjusted yield, John, are we mentally ready for Dow 10,000, which would be a negative 2% yield?
Did you just mention the Dow?
No, but like a benchmark. The Dow is a benchmark.
Just threw me there.
The Dow is the soul of the nation. Dow 10,000. So you've got real yield, negative 2% yield. That's like equivalent to Dow 10,000.
The S&P 500's up 4, advancing 1/10%. Up next. In the next hour,
negative 1.97.
Deutsche Bank chief U.S. economist.
Luzetti looks at the Dow.
I bet he doesn't. From New York, this is Bloomberg.
With the First Word News, I'm Leanne Gerrans. That $550 billion infrastructure passage has cleared its first barrier on Capitol Hill. The Senate voted to begin consideration of the bill. 17 Republicans joined all Senate Democrats and 2 independents in voting for the measure. Lawmakers expect the final passage to last into the weekend and possibly even next week. The new chair of the Federal Trade Commission is vowing to return the agency's trust-busting roots. Lena Khan told reporters she intends to use the FTC's full arsenal to take on companies that are preventing competition. Khan also signaled she's not afraid to take on risky cases that officials have shied away from in the past. China may be preparing for a period of prolonged tension with Washington. Beijing's new ambassador to the U.S. is a veteran diplomat known for pushing back against Western criticism. Chen Gang most recently served as vice foreign minister. He told reporters he would work to put U.S.-China relations back on track. And it's one of the most anticipated listings this year. Robinhood raised $2.1 billion in an IPO priced at the low end of the marketed range. That gives the trading app company a market value of just under $32 billion. Robinhood shares began trading today. Now, pro basketball star Kyrie Irving has some harsh words for Nike, which makes his signature sneaker. The Brooklyn Nets player said on Instagram that the latest version of his shoe is trash and that he had nothing to do with its design or marketing. He also said Nike plans to release the shoe without his okay. No comment yet from the company. Global news 24 hours a day, on air and on Bloomberg Quick Take. I'm Leanne Gerrans. This is Bloomberg.
It is certainly better than it was, and I expect it will continue to get better with each month as we move further away from the disruptions caused by the pandemic. But fundamentally, the only way to solve this problem is that we need to make more semiconductors in America.
Good to catch up with Gina Raimondo there, the U.S. Commerce Secretary from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Here's the price action this Thursday morning as we wait for jobless claims in America about 42 minutes away. Equity futures up 6, advancing a little more than 1/10%. Yields higher by 2 or 3 basis points to 126 on 10s. The euro stronger, euro dollar 118.74. Euro dollar positive 0.2%. Call it positive 0.25%. Crude oil, WTI 72.79. Switch up the board. This just for you, Tom Keene. Drum roll. Didi Global, 1037, up by 17%. This one surged by 30, 40% after the Wall Street Journal, Dow Jones, Tom, reported that this company was considering going private. And then the company itself denied it, and we rolled over hard, Tom.
CN Shen for Bloomberg summarizing the story right now. Didi shares surge on report. It's considering going private. And then CN goes on to try to unravel all that's going on.
That's it. We don't have to do anything else. We're done. It's good.
No,
Well done.
well, I don't know.
I know you don't want to cover this story.
I don't know. I mean, I know it's an Amazon equivalent, but that's where we are.
I think it's interesting.
Thanks, Lisa.
Anytime. Carry on, Tom.
David Wilson here to save us. A little spat within the family. David Wilson, always cheerful on growth and value, but with a geographic bent this morning. David, save us.
Oh, well, I'll do my best, Tom. Drew Dixon over at Albert Bridge Capital looked at U.S. versus Europe in terms of valuation, specifically forward price earnings ratio. So looking out 12 months.
Interesting.
And what he did was he broke down, the U.S. and Europe into growth and value using the Russell 1000 index for the U.S. and the Euro Stoxx total market index for Europe. And when you run the numbers, you find out that growth stocks here in the U.S. and in Europe are pretty much the same in terms of their valuation based on forward PEs. The disparity and the reason why U.S. stocks, historically have been more expensive than European shares arguably comes down to what's happening on the value side of the equation. Something like 18 times projected profit for the Russell 1000 value index. Look at its Euro Stoxx counterpart, it's more like 12 times. So in other words, you've got about a 50% gap between the two, and that in large measure explains why this disparity in valuation exists.
You and I have talked, that's beautiful. You and I is really, really important, folks. You and I have talked about this. Value always needs a catalyst. What's the value catalyst to get cheap Europe up to that 18 multiple?
Well, that's the challenge, is what's going to turn things around, because, you look at the bigger picture. I mean, the U.S. economy has been growing faster than the European economy. You still have the disparity in terms of the coronavirus out there. So there are a lot of reasons why this exists, but it's persisted over time. Whereas if you look at the growth stocks, I mean, the valuations have kind of come into range with each other, more recently, really this year.
So how much does this matter if the backdrop is really driven by monetary policy, by the shift in Delta variants? I mean, basically, how predictive have these metrics been?
Well, I mean, there's no doubt it's part of the mix. I mean, all you have to do is look at this year's performance for growth and value on both sides of the Atlantic. You can sort of see that. I mean, that's really the issue as much as anything. People are kind of recognizing what's going on. And, as Dixon put it, investors are thoroughly discarding European value. That's been the issue, and it's why the gap is what it is when it comes to these forward PE ratios.
All right, Dave, I want to shift gears a little bit because Tom Keene's been sending messages all morning saying we need to do more Didi. And this really, to me, is one of the most important stories of the day, especially in light of the turmoil that we've seen in the Chinese stocks. John raised a point earlier today saying that this has renewed significance because investors in the United States and Europe are looking at the likes of Didi as part of a subset of ride-sharing companies, and that basically this becomes a part of a basket of companies that people invest in. If its shares plunge or if they rise, there is a contagion mechanism within that. Are we seeing that? What are you hearing from investors on that point?
Well, I mean, one thing you can say definitely is that there's a link in terms of Didi and Uber, and I say that because, late yesterday, we reported Goldman Sachs had put up a block of 2.1 million shares of Uber. And CNBC then reported that it was sold by Japan's SoftBank to offset a loss on its stake in Didi. So when you put it together, there's certainly that relationship. I mean, it's not like you have enough ride-hailing companies necessarily for a big global basket, but there is a relationship between them as represented by what appears to be that SoftBank
It's
sale.
a huge value add. David Wilson, thank you so much. And John Ferro, what David brings up there, and I've talked about this, I'm sorry that Western banks are all involved in these discussions. markets.
Oh, absolutely. And on Dave's point, I think it's really important. The SoftBank Uber point, you don't sound what you want in these moments, you sound what you can. I've learned a ton from Mohamed Al-Erin over the years, and he reflects on his time, Tom, in emerging markets and his time at the IMF as well, where he'd go to investors and ask them about something that was happening in Mexico, and they'd say, yeah, we're selling Chile. And he'd turn around and say, what? Why are you doing that? And they would say, look, we've already taken the hit on something like Mexico. Chile's still doing okay. That's next. And that's the problem that people have. It's the contagion risk, Tom, and then the company's trying to get ahead of the contagion risk, and this can snowball pretty quickly. I don't think we've seen the end of this yet. I know a lot of people in fixed income who are super focused on Asian credit off the back of the property market in China and how this starts to bleed, Tom. It's just the beginning. Keep an eye on it. Keep focused on Asia credit, see what's happening, and keep your eye on how this spreads, the contagion mechanism for something like this that starts very idiosyncratic, Tom, and then starts to bleed out.
Lisa, that's on the edge of gloomy as you. That was the pendulum of snowballs. I mean, you know, he sounded like you for a moment.
Do I sound like you? Honestly,
Pendulum
listen, I think that just
of
sounds like a
snowballs.
rational approach to what we're seeing over in China. I mean, the regulatory risk is a big black box. We don't know what the Chinese authorities' tolerance to a sell-off in equity markets really is. And thus, you don't really understand also the interconnectivity of this market, especially as people seek to diversify in a low-yield world. I mean, you do have to think that there will be some trickle-out effect, and it could be significant if it's prolonged.
Third biggest weighting in emerging markets index on the MSCI. Alibaba.
Fair.
Number 2, Tencent, 5%. Those two names, 10%. You can go through the list, Tom. That index has changed a lot over the last few years.
Oh, more than a few years. This is a really important point, John, how EM visibility and the mix of EM has really changed from the certitude we had 15 years ago. John, what I would suggest is the compounding yield on the triple leveraged all cash fund, it's snowballing.
How's that doing?
It's snowballing.
I'm not saying this is going to explode. I'm just saying they're the kind of things that people are looking at right now for a sign that this is starting to bleed out. That's all.
Can I just say
Please
that
do.
you think that I'm the gloomy one? I'm not the one and all triple leverage all cash. I mean, the pendulum
that
of
is
triple
true,
leverage all
isn't it?
cash.
Yeah, but I have
That's a pretty bearish
It's
one, I
the
got to
most
say.
risk-averse around a table,
There
that's
you go.
for sure.
And you don't even drive.
No.
Neither do I, Lisa.
Fair.
It was like 3 different judges in 3 different courts said I had to be in triple leverage all cash.
Jeffrey Yu, BNY Mellon senior strategist, joining us shortly from New York City. Your equity market up 6, +6, and advancing a little more than 1/10 of 1%. 126 on 10s, yields higher by 2 or 3 basis points. Heard on radio, seen on TV. For our audience worldwide, this is Bloomberg Surveillance.
Unless they want to start buying equities or, putting on cheerleader outfits, I'm not sure that the Fed's going to stand by.
Some of the more aggressive timelines for signaling the beginning of tapering and perhaps starting that, you have to, again, kind of push those back a little.
Monetary policy cannot combat the major problem to the economy.
We've shown that if you give enough fiscal stimulus, you can get a strong economy.
Having some cash to deploy and look opportunistically for sell-offs is a good idea.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene, a simulcast, Bloomberg Radio, Bloomberg Television. After the Fed meeting, and we move right back into markets signaling whatever your view is. John, as we heard in the opening there's a few views out there.
I like that, Tom. Market signaling whatever your view is. Next stop, payrolls. And payrolls, we're looking for a big one, something close to 1 million. We need to see a few months of that to set us up for the taper debate. As Bank of America put it, Tom, progress on progress. And I'd add progress on progress towards substantial further progress towards their goals.
There's a headline right now which changes the dialogue in Europe. This is the Bundesbank fear, John. I know your terminal's a little slower than mine. German inflation rate rises to 3.1% above the estimate of 2.9%. That's the angst of the inflationistas, isn't it?
Yeah, very different to the angst over here, though, Tom. And if they start complaining, they're whistling in the wind. Just look at the forecast from the ECB for the next couple of years.
Exactly.
CPI, 190 this year, 150 next year, 140 2023. 1.4% 2023. The German central bank's going to have a tough time arguing the doves over to their side.
On radio and TV, we're going to truncate our opening this morning to get to Jeff Yu as fast as we can. Lisa, your observation on Chairman Powell, was he successful?
He was successful in doing nothing in terms of the market, and he was also successful in signaling that they are going to start talking about the taper debate. However, very confusing in terms of the bond market's response, what the bond market will look like, and frankly, what actually means substantial further progress other than some huge jobs numbers in the next couple of months.
John, review Didi this morning, just as we go to Jeff Yu here on China. I think it's important. Review what is going on with Didi.
Dow Jones out this morning saying perhaps they'd go private, stock up a lot. Then Reuters comes out and says, company says no. Company itself says no. This rumor is not true. Stock rolls over. Still positive, Tom, by 16%. IPO price was 14, trades now in the pre-market at 10.29. That's basically the story after a big clampdown in China. And still on this name specifically, we don't know, Tom, enough information about what this company knew before it went public and what they failed to disclose to investors. We still haven't got clear answers to that. This story's not over.
The movable feast here, folks, is the market reaction and maybe some of the childish interpretation into very sophisticated political economics. Jeffrey Yu has made a career of this at BNY Mellon as their senior strategist. John, why don't you bring in Jeffrey Yu with his perspective synthesizing all this together for Beijing?
Jeff Yu joining us now from BNY Mellon, the senior strategist. Jeff, as always, you're going to be super helpful working your way through this issue for us all. Walk me through what we need to pay attention to and what is worth ignoring.
Right. So firstly, pay attention to differentiation. What you're seeing with individual companies in China, in terms of individual sectors, the regulatory crackdown, there are different motivations behind it. Some have to do with international capital involvement, especially in the education sector. For example, they've stressed there's so much money pouring into an arms race amongst Chinese families to get their kids ahead. It's seen as damaging, so they want to treat this on an individual basis. Now, the second part of it is this framework of international investors investing in China. How should it be done? Should it be in the US? Should it be closer to China? That is something they're going to be looking at as well. And here's where geopolitics can come into the fray. Thirdly, and most importantly, I think what people are missing right now, we're talking too much about the equity market right now. We're talking too much about individual companies. What about the growth environment? No one's talked about the RRR cut that has happened and more that may come. No one's talking about the Delta variant starting to spread in multiple provinces and municipalities in China. Growth expectations are coming off. And this is what we need to be attuned to heading into the second half of the year.
Let's build on that, Jeff. The degree to which the issues in the property market now are linked to perhaps a downgrade to the outlook on the Chinese economy.
So two things here. Firstly, let's stick with property now. So any day now, normally it comes out around the end of July, early August, we get the 2021 Financial Stability Report from the PBOC. This is a brilliant report, and they look and they do stress test the entire banking system. Last year's numbers, right? If you have a 15 percentage point rise in property NPLs, amongst other scenarios, you can see capital adequacy ratios within Chinese banks go from 15% down to below 10, below the regulatory limit, right? So this is how important this is for the sector. Individual companies, they're looking at exposures as well. Is it manageable? Yes. Is it systemic? Probably not at this point. But the damage to wealth, the damage to consumer expectations and households, that will drive growth lower as well.
I look at, Jeff Yu, where we are in this, and it's not a crisis, but this moment for China, this moment for the Pacific Rim. And the elephant in the room is we don't have Hong Kong anymore. It's a different Hong Kong. How do you perceive, Jeff, the Western banks, and I don't want you to speak for the management of BNY Mellon, but how do the Western banks adapt and adjust now that Hong Kong is different?
Well, they would adapt to looking at China as a whole and the new avenues of opportunities. Right? Look at what the 5-year plan detailed. It was very explicit, welcoming foreign investment into China's industries, welcoming foreign talent to drive China's quest for self-reliance, right? So China knows it cannot grow by itself. It's going to need external expertise as well. But at the end of the day, it has to be done in a way which is manageable and does not introduce systemic risk or other risk. So going back to the education issue, for example, this is not a financial systemic risk or anything like that. It's something that's more social, and in the prism of falling birth rates and demographics, that is a serious challenge. So if foreign investment facilitated by the financial institutions, if it's seen as broadly damaging, then like any regulator globally, it's not a China-specific issue. They probably want to do something about it. It's growing pains for Wall Street and for everyone. And I think as China develops and integrates itself with the rest of the world financially, we have more index inclusion, CGBs increasing ownership. All of this is going to happen. Just calibrate it, pick the right pace, because sometimes, things, even with good intentions, you can actually end up with bad outcomes.
Jeff, this is one reason why a number of investors said that, in particular, the education sector in China, but including other shares as well, were uninvestable following a number of regulatory crackdowns over the weekend and Monday. The idea that it wasn't just education, it was also the data and the control over such things in the country. Given the pushback, the fact that authorities did have meetings with banking executives to try to push back some of this concern and shore up support for the markets, do we have a sense of how far or not they are willing to go with crackdowns, with restrictions in specific industries that could further roil markets?
So I think China is learning as well, like any regulator. This is a new environment for China. They've realized how invested in the international community is in certain sectors, right? So again, education and being one of them. So they wanted to gauge the market fallout. And if it has become excessive, and you saw the three-pronged launch from the main financial papers in China yesterday, stressing that over the medium to longer term, China is a strong market, welcoming global investors to there. So, of course, they don't want to damage sentiment either. They know how interlinked it is. And the country needs to stay interlinked. So they will learn as well from this. And as future sectors go by, maybe they'll do it differently as well. But just pay attention to the strategic initiatives. They want to communicate them better up ahead. By the way, something similar happened a few years ago to the childcare sector. Exactly the same language. Not allowed to make profit and not allowed to use capital markets to raise money. They wanted to smash a nationalized framework. It seems we all forgot about that. So this has happened again. And again, they're learning by doing, as we all are right now.
Jeff, let's put some money to work. We spent a long time talking about the risks, the framework for thinking about the situation. Where do you want to put capital to work, considering everything you've just said in the last 7 minutes?
Right. So three things here. Firstly, on renminbi, I still think renminbi trades a range, and ignoring all of the current news right now, they are worried about CPI and the PPI divergence, right? So exports are still very important. So they wanted to limit renminbi appreciation anyway. So the recent moves over the last few days, and probably it's not unwelcome. In Europe, I think what the ECB has done, very good for European equities. I think those trades and where people invest in European equities on a hedge basis, I think that will work as well by anchoring expectations. And finally, the US and the dollar, we're not ready to call time on the dollar strength yet, not by any means. It's still going to lead the way in major policy renewal and a normalization. So these carry trades, if you want to own dollar carry against the low yielders, especially in Asia, and some of the high yielders, I think they're going to falter against the dollar as well.
Jeff, interesting stuff. Jeff Yu of BNY Mellon, a strategist I've known from London, Tom, for a long, long time, and one of the sharpest in the city, that's for sure.
It's that LSE education. I mean, he synthesizes things. So, folks, this is something that we try to do with all our different guests. It's just one thing to be an expert in whatever. But, John, as you mentioned, the ability to synthesize, it's really important.
And not giving up on that dollar call. Lisa, right now, dollar index 92.
A lot of people saying that, frankly, the Fed has to be the first mover when it comes to raising rates among the big developed market banks. And as a result, what's going to pressure the dollar weaker?
That's the issue, isn't it? Well, you'd think synchronized global growth. That was the call at the start of the year, right? Let's frame the year. We came into 21. We were looking for global synchronized growth, which naturally we all thought would engineer a weaker dollar. That was the consensus view, Tom. Played out for 5 minutes. Euro dollar topped in the first week of this year, right, with a 123 handle.
Okay, but that's where I wanted to go, and we haven't gone there this morning because we're spending too much time, looking at the Didi news up and down. John, given the new milieu for Madame Lagarde and the rest, is the angst of a 125 euro, is that new angst at 122?
No idea. We're not there yet, though, are we?
No.
Where are we now? 118? Not even 119. Things can change quickly, but that's not been a concern of theirs for a while, Tom. They've got much bigger concerns.
That's
the FX channel alone is not going to solve this for them.
Or for China.
They've got a 2-year forecast at the ECB, Tom, of inflation coming back down to 1.4. I don't want to get in the business of arguing over 50 basis points. I'll let the central bankers do that. But, Tom, the ECB president herself is clearly not happy with that.
Yeah, well, same with renminbi in China. Yuan's not going to fix it for China.
Coming up, Bill Dudley, Bloomberg opinion columnist and former Federal Reserve Bank of New York president. Don't miss that conversation. It's just around the corner. Your equity market up 9, advancing 0.2%. Heard on radio, seen on TV. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. The US Senate has voted to move ahead with that infrastructure package. That happened just hours after a bipartisan group of senators and President Joe Biden reached an agreement on a $550 billion spending plan. Lawmakers expect the final passage to last into the weekend and possibly even next week. Meanwhile, senators are looking at cryptocurrency taxes as a way to help fund the infrastructure plan. The proposal would impose more rules on crypto brokers to report transactions of digital assets to the Internal Revenue Service. A summary of the plan says it will raise additional $28 billion. Now, the coronavirus surge is hampering corporate America's plans to get back to normal. Google says it will push back its official office return to mid-October. Plus, workers at its campus will be required to be vaccinated. Lyft is postponing its return date to February. Meanwhile, masks are now required at most of Apple stores over in the US. It was one of the most anticipated listings this year. Robinhood raised $2.1 billion in an IPO priced at the low end of the marketed range. That gives the trading app company a marketed value of just under $32 billion. Robinhood shares begin trading today. Citigroup's Asia Pacific Wealth Management Unit just posted one of its strongest half years on record. Citi attracted close to $15 billion in net new money across the region in the first 6 months of 2021. The bank has added several hundred wealth professionals in Hong Kong and in Singapore this year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
I actually have enough confidence in the market that most of these bottlenecks will be overcome. You know, you saw that in the case of timber prices. It went way up and then came way down. Is there any fundamental reason that we should expect this to be other than transitory? And I think the answer is no, and I think that's where the IMF is, that's where the Fed is.
That was Joseph Stiglitz there, the Columbia University economics professor from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Equity futures +8, Tom advancing about 0.2% on the S&P 500 this morning.
If you want to clear up, John, you can go to Wikipedia and you can see the theory that the pros use off of what Chairman Powell wrote yesterday. One of those expert on the theory is a gentleman from Berkeley. William Dudley joins us, the former president of the New York Fed, obviously for years at Goldman Sachs. Bill Dudley, you separate the men from the boys, the women from the girls, with the logic theory of necessary and sufficiency in an undergraduate class. You speak of the necessary and the sufficiency that we saw yesterday from Chairman Powell. What did he do that you say was not sufficient?
Well, I think that he did a good job in basically edging closer to the notion of we're going to start do the taper, but not so much so that it puts the markets on edge. The general expectation at this point is Fed probably won't start tapering, probably won't make the announcement on tapering until November or December, and probably won't start until early next year. So I think he did a good job on that. Where I would say the Fed hasn't gone far enough is the changes that they've made in terms of their standing repo facility that they announced yesterday. It's a good start to have a standing repo facility to backstop the Treasury market, but they capped its size at $500 billion, and they limited access to only primary dealers. And I think the access should be considerably broader than that to support the functioning of the Treasury market. Also, I think they need to make changes to their capital requirements so that when the Fed buys Treasuries and agency mortgage-backed securities, and that increases reserves in the banking system, that doesn't interfere with good market functioning in the Treasury market.
These are delicate phrases, and we appreciate the candidacy as a former government official. Bill Dudley, we have the overnight repo market now moving back up through $1 trillion. Let's cut to the chase here. If the overnight goes near $1 trillion, above $1 trillion, how will the Fed adapt and adjust to that?
There's no magic number that where if the Fed is soaking up $1 trillion of repo through their reverse overnight repo facility, that's not a problem. But I think it does tell you that there are consequences of the Fed's asset purchases. The banking system is essentially awash in reserves, and that's making the leverage ratio more binding, which is constraining banks' activities, and it's also causing banks to essentially push away corporate deposits. The Fed could fix this by making changes to how the leverage ratio is calculated, and I think they should do this sooner rather than later.
Is the Treasury market as it is now broken?
No, I don't think it's broken. It just needs a little bit more belt and suspenders. The standing repo facility is a good start, but as a Group of 30 report was published yesterday points out, there's a lot of other things that need to be done to the U.S. Treasury market. The G30 report talks about central clearing of treasuries for customer trades. That would make the market, I think, a lot more solid. It talks about increasing the transparency in the U.S. Treasury market. So having a standing repo facility is a good start, but there's a lot more to put the U.S. Treasury market on a firmer footing.
This may sound esoteric. It is not. It is the underpinning of what we pay for all of the loans that we take out is the underpinning, frankly, the functioning of Wall Street. And there is a question about the functioning of the Treasury yield as an indicator right now. Even Fed Chair Powell came out and said he didn't quite understand why yields were where they were. And a lot of analysts have raised the issue of liquidity, the fact that there are these malfunctioning aspects of the bond market that made it very difficult to get a clear signal from treasuries. Do you think that that is a factor in yields that are persistently low given the inflationary outlook?
Well, I'm surprised by how low long-dated treasury yields are given the level of inflation, the fact the economy is in recovery mode, and the fact the Fed has said that they're going to be very, very patient before they actually raise short-term interest rates. In that environment, you would think treasury yields would be higher. I think what's really happening is quantitative easing is very, very powerful. As the Federal Reserve buys more and more assets, that creates deposits in the banking system that people don't want to hold. And as they don't want to hold those deposits, they bid up other financial assets. So I think we're just finding out that quantitative easing is very, very powerful in pushing around bond yields and bond prices.
We toss around the phrase reaction function, Bill Dudley, in the media like it's a mint. There's a mathiness to it. Can we generate constructive reaction functions given the wall of liquidity? Or do we just need to become inured to the idea we will have jump conditions, we will have suddenness over the next many 2, 3, 5 years?
Well, we'll have some suddenness in the sense that the Fed at some point is going to go from maximum monetary policy stimulus to something else. And at some point, the Fed is actually going to lift off and raise short-term rates. The Fed, I think, is going to try to minimize that jump function by communicating clearly. And I think they've done a pretty good job in terms of, signaling when the taper might take place and that it's going to take place in a gradual and in an organized type of way.
Before we came on, we were alluding to Alan Greenspan and Bill Dudley and to Arthur Burns. And do you just assume, and I say this, Dr. Dudley, very carefully, that we have, as we become less accommodative, a measured Greenspanian approach? Are we going to go back to a Fed that's more ad hoc, like we saw with some of the sudden lifts and larger lifts in the Burns era?
Well, I hope we don't go back to the Burns era because at that time, the Fed was very, very late in terms of raising interest rates and pushing down inflation. So that would be a very bad model. I think that what the Fed is doing, though, is basically saying we don't really know exactly where full employment is. And so we want the economy to run a little hot so we can find out where full employment is and make sure we employ the maximum number of people we can without having a long-term inflation problem.
Bill, always good to get your views, especially 24 hours after the Fed has met. Bill Dudley there, Bloomberg opinion columnist and former Federal Reserve Bank of New York president. And Tom, just to weigh in on the question you asked, is something that I am calling the Dudley argument, which is the longer they wait, if they're going to be patient when they start, the argument that Bill has made repeatedly over the last couple of months is that when they start, they might have to move more quickly than people anticipate. Just the idea here that it'll be a slow start, but maybe the path from there won't be as shallow as some people expect.
With this release of this essay today for Bloomberg Opinion, John, I know we're biased. Bill writes for Bloomberg Opinion, and we're thrilled that he does that. But I'm going to make clear he is the singular former public official driving the debate.
And we'll hear from Matt Lazzetti, Deutsche Bank chief U.S. economist, on this very topic in about 5 minutes' time. Let's get to the price action of the morning this Thursday morning. Good morning to you all. We're shaping up as follows on the S&P 500, advancing 8 or 9 points on the S&P, up 0.2% into the bond market. Yields higher by 2 or 3 basis points, Tom, to 125.76. Euro dollar 118.74. Stronger euro dollar positive 0.25%. WTI 72.62. And after Amazon, do you think we can sit here and say earnings season wraps up?
No,
TK?
no.
You don't want to go there?
I don't agree
It doesn't
with that
end with
at all.
Amazon?
No, you sound
You're
like
not
a
satisfied?
media. No,
No?
I'm not. No,
What do I
Dave
sound
Wilson,
like? A
Dave
what?
Wilson keeps going.
Dave Wilson keeps going?
Yep.
How long for?
It's like 3 weeks at least.
Yeah, it's
but
pretty
it
much
tapers
over.
off. It tapers
You think it's
off.
over, Lisa?
Yeah, pretty much. I
Thank
think it's
you.
going to trickle out.
Wilson
Good to
has
have
a
you in my
taper
corner,
tantrum.
Lisa. I appreciate it.
Sometimes.
Sometimes. 90% of the time.
Yeah.
I'll take that. Heard on radio, seen on TV. This is Bloomberg. Live from New York City for our audience worldwide on TV and radio. This is Bloomberg Surveillance. Good morning to you all. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Waiting for some economic data in America. As that drops, equity futures up 8, advancing 0.2% on the S&P 500. Yields are higher by 3 basis points on 10s. And there's the number. Again, it's the wrong kind of upside surprise on jobless claims. They come in at 400K. The median estimate 385. The previous read 419. Waiting to see if we get a revision there, Tom. But it's the wrong kind of upside surprise on jobless claims. In at 400K, the median estimate 385. And GDP, second quarter, annualized quarter on quarter, Tom, 6.5%. Downside surprise there too. 8.4%, the median estimate. So the wrong kind of surprises, Tom.
Right. We'll have to watch the market reaction. 2 important data points here. And let's make clear it's 2 weeks in a row of a challenge claims on the technical. You've heard me say the chart is elegant. Well, it's not elegant anymore. And again, as John says, the revision off of 419,000 last week is important. Good morning, David Rosenberg and others cautioning about the enthusiasm over present GDP. And John, that Q2, 8.4 into 6.5 is a wow first look statistic.
Not what we were looking for. 400K is the number on claims as well. That's the wrong kind of upside surprise. 385 was the median estimate, and here's the price action. Equity futures right now still elevated, basically unchanged off the back of this, up 6 on the S&P 500, advancing a little more than 0.1%. Into the bond market we go, Tom, just to have a look at the 10-year. Yields were higher by a couple of basis points, now higher by just 1. Give it time. It's early days. With 90 seconds post the data. 124.42 on a 10-year Treasury yield right now, TK.
Chairman Powell looks brilliant off of this. And I'll tell you, John, we just got the revision in. It's a little bit above where it was last week. This is weekly data, high-frequency data. And, John, it's 2 weeks in a row. Not that it's a big deal, but you know what? It's not moving in that bull market direction. I don't mean the equity market. I mean the thinking about a constructive American economy.
And this is just the start. We've got payrolls next Friday, more data points still to come. And this is the language of the Federal Reserve in their statement yesterday. The economy has made progress towards these goals, and the committee will continue to assess progress in the coming meetings. Meetings, Lisa, plural.
Yeah.
We've got some time to work through this data, at least as far as the Federal Reserve is concerned.
Yeah, a lot of analysts on Wall Street saying that probably December is the most likely time when they'll begin their tapering. I will note that the 2-year yield is where we're seeing probably the biggest reaction. And I would argue that actually more than GDP, it's jobless claims, John, that get people's attention because this is where the Fed's focus is. They want to see progress in the labor market.
Slight upward revision to the previous month, 424. From 419. We were looking for a much, much bigger decline, though, from the previous read on claims. I said the previous month, excuse me. The previous read, 419 to 424, down to 400K, just not down to the 385 we were looking for, Tom. And as you point out, Tom, that GDP read, 6.5%. We were looking for 8.4.
We're getting to Chris Yancey starting to tear it apart for our top live team. And Johnny makes very clear consumptions there. We're going to get a breakout on that data as it comes along. But again, that goes to where David Rosenberg is, which is not the numbers we're looking at right now, which is the last 3 months. But where are we right now? And John, that is a raging debate. Let's go right to this right now with Matthew Lazzetti. Thrilled he's with us with a more optimistic Deutsche Bank right now. Matthew, this data, totally unfair question, but it's Unfair Thursday. Does this data allow Deutsche Bank to adjust to a more cautious economic growth?
Sure. Thanks so much for having me. I don't think it in and of itself really changes too much. We'll have to see the details there. It looks like consumer spending was actually a good amount stronger than expected in Q2. I think the key question for the growth trajectory over these quarters is actually a lot about inventory. So inventories was expected to be a big drag in Q2. We expect to get a big boost in Q3. But I think you're absolutely right. This data is backward looking. It is Q2. I think what is most important for markets and the Fed right now is the labor market data. And the stalling out of jobless claims that we've seen is an important development. Jobless claims have not been as reliable as they were pre-COVID, but it is evidence of some stalling out or some softening in the improvement that we've seen there. If that continues, it's certainly an important development from the Fed's perspective, because Powell noted yesterday, certainly that is the key consideration for when they are going to taper.
Matt, for many people, September and Q4 is just huge. It's going to be massive to shape some of these debates. Goldman out earlier this week suggesting that full service sector recovery is going to take a little bit more time. They downgraded their estimates. Where are you and the team at Deutsche Bank on that argument right now, Matt?
Sure. I think there's, this is the area of debate. We have expecting goods spending to be coming off, durable goods spending, housing to be coming off. And we were anticipating that services would help lift the economy to a stronger growth profile in the second half of the year. Obviously, the return of COVID and the Delta variant is a downside risk to that. But I view it as a downside risk, not something that impacts our baseline outlook significantly at this point. I think Chair Powell made a good point yesterday. If we look back at these past waves, they were not as impactful as we were anticipating. I anticipate that will probably be the case again. And when we look at those states that are probably most susceptible, that have lower vaccination rates, I think they're also less likely to bring back restrictions. You're also less likely to see those people pull back from economic activity. So it is no doubt a downside risk to growth over these coming quarters. But that's how we're viewing it, not impacting our baseline outlook at this point.
Matt, when you dig under the headline of the GDP number, are we getting whiffs of stagflation? And I know that this is the pendulum of doom. However, residential investment spending fell about a 10% annualized pace. This has to do with supply chain issues, a lack of lumber, and of course the high prices. Are the high prices a headwind to growth at this point?
I think in certain areas they certainly are. Housing is one, and yes, there are supply chain issues, but we're seeing demand come off. Mortgage purchase applications have weakened. Prospective buyer traffic has softened, so demand is being impacted. But I don't want to just focus on the prices either. We've seen, durable goods spending was 16% above where it was pre-COVID trend. Housing jumped above the pre-COVID trend. So this is a very unusual recovery. It was a very unusual recession. And we've been anticipating that these cyclical sectors will come off, even if you didn't get these price pressures. So that does make the services sector really critical to the trajectory of the economy from here on out. And we do think that it will help to carry stronger growth over the second half of the year.
Do you think that this is indicative, the weakness, or at least the disappointments that we're seeing in economic data points? I don't want to call a 6.5% growth weakness, but we have gotten disappointment after disappointment. Does that indicate a trend that will carry into the end of the year, or could things change in September when kids supposedly go back to school?
Yeah, from a labor market perspective, I think we are all anticipating, and Chair Powell and the Fed is certainly anticipating that will help to open up labor supply. We have focused on COVID as being a big driver of the constraints on labor supply, not necessarily the unemployment insurance benefits. And so whether or not schools are able to reopen significantly in September, fully in person, I think is a critical question for the labor market outlook. At this point, we just don't know. We'll have to see how the variant evolves over the next couple of months, how policy evolves over the next couple of months.
Yeah.
But that will be a really important consideration for getting back to maximum employment or these types of labor market numbers that the Fed wants to see.
There's a lot we don't know. There's a couple of things we can take a good guess on. One of them is inventories, and you mentioned that earlier on, Matt. This is what Luke Cower had to say of UBS. The 1.1 percentage point drag from inventories in Q2 is just not sustainable in the slightest. Yesterday's drawdowns equal tomorrow's demand. Matt, would you go with that as well? That seems to be what has led us towards this downside surprise this morning.
Absolutely. So we were below consensus on this GDP print. The key driver of that being a big drag from inventories. We know we have in the retail and especially in the auto sector, very low inventories, which we expect to begin to build in the second half of the year. And so I think what you tend to see in these numbers, if private final demand is actually pretty strong, which it looks like it might be given the strong consumer spending, you should get a reversal of inventories, and that should help to lift your Q3 growth number versus Q2.
Malizetti, I'm going to use a word from Jean-Claude Trichet that he loves to use, and he says it with a French accent, which has got a lot more panache than you and I are going to do, and that is diffusion. There's a belief here and a mystery about the diffusion from a goods-centric consumer over to a service sector consumer. Do we see that in this data, or does that wait for another quarter's report?
We have been seeing it in the monthly data, no doubt. We've seen good spending, retail sales in nominal terms has flatlined out over the past couple of months. And adjusting for prices, given how strong price gains have been, we've seen weakness in real spending on goods. I want to emphasize that was to be anticipated. We were well above trend on goods spending, and price pressures are obviously having an impact. So we expect this handoff to the services sector to continue over the next couple of months, next couple of quarters. We're still below where we anticipated we would be in leisure and hospitality and all these other service items. So I think that should continue to be the key driver for growth going forward.
Matt Lazzetti of Deutsche Bank. You're not alone, sir. It's good to catch up. Thank you very much. This from Neil Dutter of Renmac. Inventories cut GDP by 1.1 percentage point. This was a significant part of the miss. Eventually, inventories will need to be brought into line with final demand. When that happens, top-line GDP growth will surge. This is good news for future factory production. Just some of the takes from Wall Street this morning, Tom, off the back of this miss. Looking forward, the look forward, still, the consensus view is, as this year grows older, Tom, the supply side of this economy will heal in a more profound way, and maybe we can solve some of these issues.
I would say the partition between the optimists and those more cautious is when does service sector growth really click in? We don't see that here, but maybe we'll see indications rapidly towards where we are in Q3.
And on that point, Tom, Lisa, just a final word on this. To what degree, to what extent has that been delayed, given what we've seen over the last couple of weeks?
And especially because we're not seeing the frictions in the labor market really resolved. And I want to just emphasize that, yes, there are there's a forward look in the GDP figures that's more positive. The jobless figures, stubbornly high initial jobless claims. And you just wonder why.
We're going to have that conversation in about 15 minutes' time on The Open with Sibaja Rajappa, Societe Generale's head of US rate strategy. David Kelly of JP Morgan joining us as well to work through some of the issues. Your equity market, not doing much today, up 7 points on the S&P 500, advancing a little more than 1/10%. The dollar breaks down a little bit, negative 0.4%, a weaker dollar. The dollar index breaks back down through a 92, 91, 95. From New York City on radio, on TV.
Didi, $10.44.
Thank you, T-Cat. Knew it was coming. I'll leave the space for you. Just left it there. Anything else?
Didi.
You good?
Didi.
Okay, Didi. You enjoy your time off. I'll see you Monday. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. That $550 billion infrastructure passage has cleared its first barrier on Capitol Hill. The Senate voted to begin consideration of the bill. 17 Republicans joined all Senate Democrats and 2 independents in voting for the measure. Lawmakers expect the final passage to last into the weekend and possibly even next week. Now, the new chair of the Federal Trade Commission is vowing to return the agency's trust-busting roots. Lena Khan told reporters she intends to use the FTC's full arsenal to take on companies that prevent competition. Khan also signaled she's not afraid to take on risky cases that officials have really shied away from in the past. China may be preparing for a period of prolonged tension with Washington. Beijing's new ambassador to the U.S. is a veteran diplomat known for pushing back against Western criticism. Chen Gang most recently served as vice foreign minister. He told reporters he would work to put U.S.-China relations back on track. It was one of the most anticipated listings this year. Robinhood raised $2.1 billion at an IPO priced at the lower end of the market range. That gives the trading app company a market value of just under $32 billion. Robinhood shares do begin trading today. Comcast beat estimates for second quarter sales and profit. The company signed up a record number of new internet customers. Meanwhile, there was a surge of advertising revenue at its NBC Universal division. Comcast continues to lose cable customers as more people turn to streaming. Still, 399,000 video customers who dropped the service were actually fewer than were expected. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
straightforward solution. Support and grow more American-based companies. I can sum it up in 2 words: buy American.
President of the United States talking of Buy American. We'll talk about that in a moment here, and of course how it wraps into legislation as well. It is an electric car company, and it has been statements made from the gentleman from Utah who basically came out of school as a sales and marketing executive and now is a bit challenged. He is Trevor Milton of Nikola, and it's real simple. The U.S. attorney in New York unseals an indictment against Trevor Milton. We'll have much more on this, and I believe there is scheduled a press conference by U.S. attorneys at 11 a.m. Bloomberg will be following this on the island of Manhattan this morning as well. Right now, and this is really, really important for your infrastructure, we go to the gentleman from Flint and on up to Saginaw and Bay City. Dan Kildee is someone with a real view of America, different from maybe inside the Beltway in Washington, and we're honored that he could join us from inside the Beltway in Washington this morning. Dan, you and your family and your constituents have lived the worst water crisis in America. You know better than anybody about lead pipes, about water structure. Is this bill good for Flint, Michigan?
Well, it's hard to say. It's a step in the right direction. The question is whether or not there's enough of an emphasis on water infrastructure to prevent the next Flint, Michigan from happening. In some ways, and ironically, Flint has some advantage in the fact that the failure of Flint's infrastructure occurred in public view. I was able to get help for Flint, even when I was in the minority, to replace the lead pipes there. But the real question is, will the warning that Flint provided the rest of the country be heeded? Will we have enough money in this legislation to replace every lead pipe in America? And I'm not sure yet we do, but maybe it's a step in the right direction.
In the third world crisis of Flint, Michigan and water, there was no discussion of pay-fors. It was like, let's go, let's fix it. How do you respond to this juvenile debate over how we're going to pay for this versus let's go?
Well, the way I respond, it's a really good question, is to point out that when it comes to water infrastructure or other infrastructure failures, we're all going to pay for it. The question is, you can pay now or you can pay later. Flint's a good example. If Flint, say 7 years ago, had $30 or $40 million available to switch out its lead pipes, we would have saved what is now approaching $1 billion in costs of compensation to victims, of fixing the infrastructure after it's broken. So yes, we do need to come up with a way to pay for it, but we can't start with the premise that we're not going to pay for it if we don't do it. If we don't fix our infrastructure, there's a big due bill coming our way, much bigger than the cost of fixing it in the first place.
Congressman, $550 billion in light of the fiscal stimulus passed over the past year is not that big, especially when spent over 8 years. How much in the conversations that you have and the negotiations that burn the midnight oil as you eat tacos and chicken parm each night as you try to hash out the details here, how much of the debate is connected to the $3.5 trillion plan that Senator Sanders is working on right now?
It is connected because if, in fact, we have a bipartisan deal, and the president, many of us have been very committed to do as much as we can in a bipartisan fashion. That doesn't mean our work's done, but it pushes more of what we may need to do into a reconciliation package. And the concern that I have is that some of our senators who seem willing to work together on the bipartisan piece get a little cold feet when we think about what we want to put into the reconciliation package. And I'm talking about Democratic senators in this case. We've got a lot of business ahead of us. If we don't fix this stuff, it doesn't mean it goes away. It doesn't mean that China is not spending 10 times what we are as a percentage of their GDP on infrastructure. What I'm trying to convey to my colleagues is we really don't have a choice. We have to do this. We can't have an infrastructure bill that says 1 out of 4 Americans get to have 21st century infrastructure. The rest of us have to compete with 19th and 20th century infrastructure. Sooner or later, we got to fix it. And so more of it may have to be pushed into that reconciliation bill if we don't get enough in the infrastructure package itself.
Which raises a question, Congressman, about unity among Democrats. There's been a lot talked about the splintering of the party, the whole progressive versus the more moderate wing. Given the conversations that you're having, how difficult is it going to be? Can you characterize whether people are coming together and coming to a more unified vision here?
It's hard. I mean, one of the things about having a party with a lot of diversity of thought is that we have a lot of diversity of thought, and it's often hard to land on the same spot. The tough thing is, if we're all being asked to compromise, we all have to compromise. We can't have a situation where somebody on the left says the right has to compromise or the middle has to compromise. If we're going to come together, that means everybody's got to acknowledge that the final product is something that if they were doing it by themselves, they wouldn't do it. And right now, I'm not sure we've completely landed that message. I think too many folks are taking an absolutist approach that without my specific priority, I'm not going to help. And that is not the way this place is designed to work. And the American people don't care what the excuses are. They just want us to get this work done. They want us to get the work done that affects their lives. You know, the Beltway arguments are of no interest to the people I represent.
Dan, I got like 14 more questions, but we don't have enough time. Dan Kildee of Flint, Michigan, thank you so much for joining us today. The congressman from the 5th District in Michigan. Lisa, what's so interesting about that conversation is this is a guy with a whole family heritage of the district, and he's part of what's called the Free Thought Caucus in Washington. I think there's like 12 members. That's all they could get looking for reason and science within the debate of public policy.
Free thought, Reed centrist. And frankly, they are leading the whole ball here when it comes to driving some sort of bipartisan agreement. Yeah. So interesting to see how they're going to wrangle all sides, both for this and for the $3.5 trillion spending plan. Can I just say something, Tom?
Oh, please.
As we were talking, MasterCard released earnings. And I think that this is actually quite interesting because it goes to card spending. Card use in the U.S. soared 36%, just to give you a sense of how big this was. And purchase volume climbed to $1.47 trillion. This is way ahead of estimates. Yeah. The whole idea of the consumer is strong. We saw that in the GDP spending, and that really it's more supply chain constraints and getting inventories that's holding up some of the growth. But to me, as far as the consumer goes, they've got a lot of money. And they're spending it.
And there'll be a second look. Let's remember, there's first look, second look, third look to any GDP, and even after that, years is revision. But I agree with a lot of the people, John Farrell mentioning Neil Dutta earlier, that let's focus on where we are right now. And dare I say, Lisa, there's a huge mystery right now to Q4. I mean, nobody has a clue.
And a lot of this has to do with how quickly some of these frictions get evened out. And that's the flip side of this. Corporations saying it could be a pretty long runway. So these are sort of, the push-pull effects.
Stay with us. Also, the news through the day on the pandemic and on masks in the CDC. Part of the conversation, Balance of Power, 12 noon today with the senator from Florida, Rick Stock. Please stay with us. This is Bloomberg. Good morning.